Right, good morning, everyone. It's a pleasure to be here. Just do some brief introduction. My name is Ayola, CEO, co-founder, Umbrella, and you're welcome to Umbrella Saturday, another edition of Umbrella Saturday. While we wait for some of our guests to join in, what I would like to do is just run us through what Umbrella Saturday is, just to buy some time. Our host, our speaker today, Ernest, is in the house. So we just go through some of the things that Umbrella Saturday is while we still get more people to join in on the call. So basically, Umbrella Saturday is a high impact weekly Zoom webinar hosted every Saturday. And we have some special editions that we've introduced, usually hosted on Friday. It's basically a curated session where we have speakers with deep insight, domain expertise across critical areas of the startup journey. In their own rights, they are startup founders. In their own rights, they are VCs. In their own rights, they're angel investors who basically have moved from product development to fundraising to growth marketing or legal or financial and technical expertise. Like I said, myself, Ayola, I have over 14 years experience in brand and brand business building, as well as have worked across different sectors, from advertising agencies all the way to media agencies to startup, Ope, Patricia, Intense. I've also, in my own right, been a founder, where I have also I have two startup, currently building the third one, called Flexa app. So what is Umbrella for? Basically, startup founders who are seeking clarity, mentorship, and access to real-world expertise. Investors who are scouting for high-quality, verified African startup in various stages. Ecosystem advisors and operators looking for opportunities to share knowledge with the ecosystem. And then, of course, corporate partners who are aiming to position themselves as innovators. What's in it for you as a founder? Access to industry experts and actionable insights, free platform to pitch your ideas and receive live feedback, exposures to investors and key ecosystem players. As an investor, of course, is direct access to verified pipelines and investment-ready startup, early-stage deals flow, and then, of course, sector-focused conversations to match your investment thesis. And of course, our speakers and advisors get visibilities among African emerging founders, as well as talent. The opportunity for them to influence the startup thinking and direction, and of course, an opportunity for partnership with their platforms. Why must you be a part of the Umbrella Startup Day? Of course, Umbrella basically is built on trust, and we are creating this across the ecosystem from our speakers to startup. All the contents are vetted and relevant. So we're also very data driven. We're founders first. Everything about the Umbrella Saturday webinar is for the founders, for them to get real value and insight, as well as of course, it's an access for a soft landing deal flow, where you can do a demo day and the rest of it. We've had 8 sessions of Umbrella Saturday. We started in May. This makes the 9th session with Ernest Bosha of Pulaspace, who will be on our venue speaking to us. The last two after Ernest would be Benjamin. Sorry, just a minute. Let me admit some of our people on the wait list. Yeah. So after Ernest, you have someone coming to speak to us on Lagos to Toronto. His name is Ben Sheon Oyajumo. He's a founder of his startup. And then you also have someone who is very key to us. He's been an advisor on Umbrella. His name is Mr. Bade Aluko. He's been an advisor with Techstars, and he's also an angel investor. He runs White Hibiscus Capital, which of course is a venture investment platform right here in Nigeria. Um, of course, what makes us different, we've engaged over 300 plus unique founders. We're community powered, data driven. We have verified pipelines of startups, multi-stakeholder experiences. And of course, like I said earlier, Umbrella Startup Day is not just another webinar, is of course Africa's most reliable digital gateway to early stage deal sourcing, expert insight, and startup investors matching. Once again, welcome to Umbrella Saturday. Now I will be introducing our speaker for today, Ernest Bosha. Ernest, thanks for joining us. I would allow you to do yourself the honors of introducing yourself, telling us what you've been through, your journey. And how Umbrella Saturday usually is that we usually have a lot of feedback sessions while you're going through your presentation. And I know this is the second one we're having where the speaker doesn't have a presentation, but is speaking with a wealth of knowledge from their notes. And I want to ensure that the founders who are building within the fintech space get a lot to learn. We're speaking scrutiny and regulations today, and I'm sure a lot of people want to know how you've also navigated this terrain. So, Ernest, welcome again to Umbrella Saturday, and you can unmute yourself to speak.
Hello, everyone. Hello, Ayola. Thank you very much for having me today on Umbrella Saturday. I hope you can hear me clearly. Okay, all right. Um, uh, I'm Ernest Bosha, as Ayola has introduced. Like most of you here, I've been a startup founder. I've been a regulator, and I'm currently transitioning to becoming a VC. So going through the entire cycle of the startup ecosystem. Um, I I studied economics in school with a BSc and a master's in economics. Um, I had been a founder of a startup called CloudMap with some friends of mine. We built enterprise solutions for businesses, and we also built an event management platform. Interestingly, just before COVID, and then COVID happened, and then COVID happened, and events went online. Interestingly, we tried a pivot at the time to host events online. We hosted online parties and all of that, and it was a fun experience. But we shut down CloudMap, and then I moved to the Central Bank of Nigeria, where I spent 5 years as a research economist and then as a policy analyst in fintech and payment systems. So within this central bank, I was very much at the forefront of implementing three key projects or initiatives for the bank. On the one hand, yes, I was very much involved in policy making at the central bank, especially fintech policy and digital assets payments system policy. And then I also, together with my boss, managed the regulatory sandbox for Nigeria, where we had a host of innovative startups who whose solutions didn't fall within a very specific regulatory framework or a very specific license category. And so we managed them, we incubated them in collaboration with NIBS to test out their products. Some of them are startups that you know quite well, like CredRails, Regfile, and a few others. And then I also was a program manager on the Central Bank Digital Currency Project for Nigeria, the eNaira, which I'm sure most of you had heard about when we were trying to launch that. And then I also managed the Open Banking Initiative for the Central Bank of Nigeria. Fortunately, the open banking initiative has been approved and should go live by next month. So after my time at the Central Bank of Nigeria, I've moved to Pulaspace, which is an enterprise support organization. We are currently in the process of raising a $10 million VC fund to back startups in smaller ecosystems in Africa, because we see the concentration of VC funding in the large markets, the big four, as we refer to them, and our understanding is that innovation is evenly distributed across the continent, while venture funding is very much concentrated within those four markets, and we want to be able to leverage the capital and a beyond capital model to support founders and startups in those smaller ecosystems. So yes, that's by way of introduction. That's me. That's my background, and that's what I do. And today, I'll be talking to you about from scale to scrutiny, navigating the fintech role in Nigeria. Thank you very much.
All right, great. And Ernest, my first question to you is, there's the assumption that regulators do not always consult the founders or speak to the people who are involved in running the business. Regulators just come with rules, and then they make it difficult for founders to scale, right? I'm a startup founder, right? And I'm in tech. I'm trying to solve a problem, and the regulators are saying I need to get a license that is way bigger than even my dreams, right? Because revenue, I'm not even started making money. And those are like some of the conversations that I've had, startup founders go out there to do. I know the job of the regulators most times are to keep checks and balances so that, people, especially when it comes with financials, people's money don't get missing. There are not a lot of stories here and there. You don't want to startup founder that picks money from you and then tomorrow it has disappeared in the air, right? Hence the reasons why you have some of these regulators, in the house. I'm sure it's going to be a full house very soon, because I see a lot of people just coming in, tripping in from it's a Saturday, it's a weekend. But talk to us about regulators. What is the process for regulation?
Okay. So thank you very much for that question. And it's a conversation, as you said, that is very much part of the ecosystem where there's this mismatch in expectations between regulators and operators. And what I'll say to that is this mismatch comes from a very serious divergence in terms of responsibility. Right. So by law and by statute and by the position of a regulator is responsibility is to ensure safety and protection for all the participants it relates. That's the first function. So if you see, for instance, at the Central Bank of Nigeria, in the CBN Act 2007, which is under amendment right now, our responsibility was first monetary stability, which is prices, inflation, keep inflation low. And the next one is financial system stability, which is that the financial system as a whole, comprising of the operators, the service providers, from banks to payments, and all of that, was stable enough to support growth, which was our third objective. So monetary stability, price, financial stability, safety of the financial system, and then employment, which is economic growth. So in that sense, you then juxtapose that against the position of an operator. An operator might have, or a fintech startup or a startup as a whole would have three basic functions. One is growth, right? So if you are within the startup ecosystem, what differentiates you from someone who is in the mom and pop shop is that hyper growth, hyper scale that you're able to achieve. So the first thing is growth. And sometimes it's even growth at all costs. We had a long period where it was growth at all costs. The second thing you want to do is to maximize shareholder value. for your investors and your employees and yourself. And then the third thing is to capture market share to a large extent, because every good startup, as Peter Thiel and the Silicon Valley overlords would tell us, would tend towards a monopoly, so to say. You want to acquire as much market share as possible. So where that is where the divergence comes from. The regulator's responsibility and the startup's responsibility are different. Now, where regulation works is balancing the need and the drive for innovation with the appropriate safeguards, guardrails, and protections for all participants, including the operators themselves. Because for as you said, if we've had instances over the past few months where startups are closing down, right? And are failing. Now, if we do not have recourse mechanisms, we do not have wind down frameworks, we do not have these regulations in place. When a startup falls like that, the entire ecosystem, the entire financial system is at risk because there are a lot of spillover effects. And I'll give an example. Let's say there's a startup and it's a payment startup and it processes payments and collections on behalf of merchants and individuals. And that startup has nominated a settlement bank on his behalf because the startup doesn't go to the settlement process. It just collects and the bank goes to settle, make sure that everybody gets their money at the end of the day. If that startup was to shut down today, suddenly, and there was some money in balance that had not been cleared and settled, without proper regulation, it would mean that people would lose all their money. And for some of these people, it's their livelihood. And for us as regulators, we would think that if that happens often, what would happen is people would now lose trust in the financial system. We will now go back to where people are keeping their money under their bed, which is what we do not want. So that is the kind of game, so to say, the kind of balancing act that will play. But for the Central Bank of Nigeria and um, most regulators that are more forward thinking, where you get this balance is through a consultative and collaborative approach. At the Central Bank of Nigeria, I was very much part of open banking and the regulatory sandbox and even policy making. Now, most of these policies that came out, we had to consult with the ecosystem. So if we draft a policy, the initial draft, we draft it in-house. The next step of that is we take it to us, to the people upstairs, the decision makers. When they say, oh, we like how this looks, the next step of policy making is consultation. So we gather people in the ecosystem in a room and we say, look, this is an exposure draft of a policy or a guideline that we're seeking to bring out. And then we give a period for feedback. Now, we've had instances where that feedback has led to some changes. And I'll give you a practical example. About 2 years ago, when we wanted to change the structure for international money transfer operators, and we had a far higher threshold in terms of the minimum shared paid up capital that we wanted to bring up. But when we exposed it to the ecosystem, the player said, look, this is too high. It would make it very difficult for Nigerians, for local entities to be able to meet up. So what did we do? We said, okay, first of all, suggest something. And they suggested within a band. And then we brought it down to 1 million. And we said, you don't have to bring $1 million cash to us even. If you are a Nigerian entity and you want to pay your minimum paid up capital, whatever the rate of exchange is that day, pay in Naira. So you don't have to go and source FX. So in that way, we've made a move more towards the side of the operators to accommodate them. And that happens a lot in most policies that come in. So yes, there's that, and there'll always be that continued strife between operators and regulators because we have very different objectives. But collaboration and a consultative approach would make sure that that divergence is not too much, which is the approach that the central bank and most advanced regulators are taking on board.
All right, I hear you, Ernest, and I know that you have your notes that you've planned for this session. But just before you go into it, What inspired your interest in regulatory framework and compliance, and especially in the Nigerian fintech space? What inspired it for you?
Okay.
Because
So
I hear you speak with a lot of passion, and you are the best regulator, founder turned regulator, regulator turned founder that I see, with this passion. When regulators are talking, they're talking more from a place of instruction. This is what you should do. This is what you should do. This is how you should go about it. You go left, we penalize you for going left.
yeah, there's a place, of course, and a time for instruction because founders or operators would always, as I said, they'll always try to. I within the bank, I was always of the position that it's the responsibility of founders to try to look for how to optimize their outcomes within the frameworks that you make. Now, it's our responsibility to make sure that we are quite, as I said, quite hard and quite instructive when we make our positions clear. And yes, we do that. But in terms of inspiration, now you have to recall that I was a founder myself before I got into the bank, and I'd seen the trajectory of innovation within the ecosystem, whether it's fintech or the entire startup ecosystem. So when I got into the bank, even though my initial position was a research economist, being a founder myself, I was interested in how the the regulator was able to come up with these policies. What was the process behind it? Because I knew how this affected the ecosystem. And so I wanted, it was just out of curiosity to learn and to better understand, to have a holistic viewpoint as to how these regulators come about the policies that they make. Because I had been on the founder side and seen how these policies affected me. Now, not all of them were negative, but of course, we see some that were quite stifling to the ecosystem. So, my main motivation, to be fair, was curiosity and a desire to learn and to have a better understanding of what was going on. So that was my motivation for getting into compliance and policy.
All right, I'll let you take your scripts, but be ready for a lot of questions today. I'm sure there are a lot of founders who are building fintech or trying to go into the wallet system, thinking what kind of license should I get. So a lot of conversations are going to be out today, but let's have you.
Okay. So, for my, I'm very much open to the conversations, and for my own talk, what I want to take us through is briefly, I'll take us through how regulation has been important and has been fundamental to the evolution of this fintech ecosystem that we so love and cherish. And I'll then take us into what the regulatory landscape is itself. And then I'll take us through what the basic frameworks and guidelines and structures for regulation are. And then the next thing I'll do is to situate how regulation and compliance actually works in your favor as a startup, as a fintech startup, and how it positions you better, not only for fundraising, but for scale uh, moving forward. And then we can open it up for questions. So in 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 terms of where we are now, we've all seen the evolution of the fintech ecosystem to become, should I say, the preeminent startup sector within this country and across the continent as a whole. Over 72% of startup funding last year into Nigeria was raised by fintech startups. And if you look at the data from 2019 to 2025, Q1, you see that it's around 60% of total startup funding that has come into the country, which is anywhere between $2 billion to $3 billion within the last 6 years, has been to fintech startups. And then the sheer number of these startups themselves, as at 2017, we had barely 80 fintech startups. And by Q1 this year, we have over 400 fintech startups, which shows us the level of growth that we have experience. Now, none of this would be possible without regulation and policies. And that is a statement I make very seriously because the entire infrastructure upon which we are layering our wallets, we're layering our lending products, we're layering all of these wonderful innovations that we see, the credit and all that, would not be possible without the actions, the policies, and the regulations that have been put in place by regulators. And I'll go through a few of them from the central bank side. So in 1993, the banks at the time and the Central Bank of Nigeria came together to build a shared infrastructure for clearing and settlement across banks, an infrastructure that was interoperable. Now, before then, any kind of settlement across banks was done on a bilateral basis. So if your bank did not have a bilateral arrangement with another bank, you couldn't transfer money from your bank to another bank. You couldn't go to another bank and just willy-nilly make a deposit or make a withdrawal. Now, this structure was called NIBS, the Nigerian Interbank Settlement System, and it became operational in 1994. And since then, it has provided the bedrock of the entire fintech infrastructure that we have in this country. Now, another important development came around 2004, right, when the CBN once again with the operators decided to make ATM and point of sale devices interoperable. So now you could take your card and go into any bank's ATM and you'll be able to withdraw, or you can go to any POS and you'll be able to withdraw or make a deposit. That was an important step in development of this ecosystem because now most of us who are here, who are young, apart from Ayo, who is a senior man, most of us who are
I'm young. What do you mean by that? Hey, take back that statement.
most of us who are young would not even be able to comprehend the fact that, oh, before that time, you couldn't take your card to just any point of sale device, right? Because it's so natural, it's so normal to what we are doing these days. But before then, you couldn't do that. And then, of course, another development that came in handy was in 2007 when the central bank had the Payment System Vision 2020. That was the first time we had a structured strategy framework for how we envisioned the payment system in the country developing over time. So it had some very important pillars. One was that we wanted to comply with global standards for payment, which included the PCI DSS for card certifications, the PCI DSS for card certification. We had the EMVCO certification for cards, enabling them to be acceptable across the globe. We had as part of that the move from T+3 settlements, which of course all of us young people cannot relate with T+3 settlements. The fact that you paid today and it took 3 days before it settled in the other person's bank account. We wanted to move from there to T+1, and then finally by like 2019 we wanted to move to 4 settlement cycles in a day. So you didn't even need a whole day to end. So there were very important structures that were put in place in 2007 under the payment system vision that have guided the development of the ecosystem. Then 2011, which is a very important year in the evolution of these payment system and these fintech ecosystems that we have. In 2011, there were some very important frameworks, policies, regulations, initiatives that came on board. One was the initial cashless policy. Now, for the first time, there was a concerted effort to move people from cash-based payments to digital-based payments. There was sensitization and education across the country. There was a removal of charges for people who would come and deposit to encourage people to take cash out of their bedrooms and under their pillows into banks. And then that level of education brought an increased level of trust within the banking system. Because if you remember, in 2010, we had done a reconsolidation of banks after the whole turmoil of 2004, 2005. So now this cashless policy, this sensitization, this education brought a level of trust in the revamped banking and financial system that helped spur the adoption of digital payments. In that same 2011, the central bank and the Nigerian Interbank Settlement System introduced NIP. Now, NIP is the most wonderful boon or boost that the fintech ecosystem has ever had. Every single payment product that you use today is built on NIP. Whether you're using Paystack, you're using Flutterwave, any payment that you're doing today is basically based on NIP, which was the NIP's instant payment service. It allowed bank to bank transfers to be paid instantly, cleared and settled within the 4 settlement cycles in a day. And that changed the whole game for everyone. The next thing in 2011 that was very important was the institution of the mobile money licenses. Now, before then, you had the switching and processing companies, eTransact, InterSwitch, and all of that. Mobile money services allowed new players to enter into the ecosystem. Some of the names that we see today, Paga, Kudi, which is now owned by InterSwitch, Paycom. Ayo would know this for sure. Paycom was also one of those early licensees, Cellulant and a few of them. That was the first wave of the fintech startups, in quote, that came to leverage a licensing arrangement that allows them to offer wallet services, that allows them to offer collections and payments aggregation pool system. Because why I said I would know Paycom is because Paycom was the company that OPay bought and started leveraging its license. And today we all know OPay, we all know Paga, we all know Cellulant, we know InterSwitch, who had Kuzi, we know eTransact and Feds and the rest of them. Now, these early adopters were able to further drive the evolution of our system. And that was on the back of this license that the central bank had put in place. And then in 2013, we had another important development, which was spurred policy. That is the introduction of the new real-time gross settlement system and the new scriptless security settlement. Now, for some of us, we might not understand how that was important, but a real-time gross settlement was what allowed us to have several settlement cycles in a day, one. Secondly, it was what set up the mechanism for collateral and securities that allow you as an operator that might not have settlement facilities, that you do not have the 15 billion naira that is required to be a settlement bank, but you can appoint a settlement agent on your behalf who takes all your payments and goes to settlement and makes those settlements on your behalf with all the banks that you have outstanding. Now, this made things very much easier because imagine you as a new startup needing to stump up 15 billion. You don't have that money to be able to deploy. Even if you have that money, there are better uses for it. And then the scriptless securities settlement system was integrated with the Central Securities Clearance System, which is the CSCS, that powers brokerage and trading on the Nigerian Stock Exchange. So that gave birth to e-dividend payments within Nigeria. So for the first time, you didn't, once again, Ayo would know this because he's our senior man in residence. But before then, for you to know how the performance of your bank and then get or whatever entity on the stock exchange that you had securities in, the bank will literally send you a large folder with the report for the year via DHL or whatever postal service was available, and you have to read it to know, oh, this is how much dividend I have for this year. And then you would have to go to a bank or to a broker and fill out your forms to be able to claim your dividends and all that. So the scriptless system allowed for the first time e-dividend payments. It allowed, and which From there, and from which allowed digital brokerage. Now you have digital brokerage firms. You have fund managers and brokers like Bamboo. You have Rise. You have Chaka and all of that. That would not be possible without the new RTGS and the scriptless system that the bank put in place in 2013. Then one of the biggest ones in 2014 was BVN, right? So for the first time, the country had a structured single point of identity for people in the financial system, a single bank verification number that did a lot of things. One, reduce fraud because you had proper identification. We see how much fraud happens in the system now. It's nothing compared to what used to happen in the past. People impersonating people, identity theft, and all of that was rife in the banking and financial system until the introduction of the BVN in 2000 and 2014. And another part of it that is very important to the fintech ecosystem, besides the identification, it's the ability to link all your bank information to one point of identity. So that siloed system was brought down by BVN. Now, that it's what enables people like Mono, people like Okra, which is evolving at the moment, and the rest of them that are one pipe, and the rest of them to be able to go take just your BVN information, engage with a credit bureau and find details of all your transactions and all your payments activities across all the banks that you hold an account with. Now, as you've seen, there are several products that have been able to build, and several of the digital lending products leverage the BVN and need access to your entire banking information to be able to offer their services. So the BVN was another thing which came from regulation in partnership with operators because the bankers committee was very integral to this. And then the new license categorization for the payment system in 2020 was another important step. That was where we broke down the different payment activities. We said, okay, this is a payment service solution provider. This is a payment terminal solution provider. This is a switching and processing license. This is a super agent, and they have different functions. They have different type of services they can offer. This is the limits to the services that they can offer, and this is how much would be required for minimum paid up capital and all of that. That brought a lot of clarity into the activities that a lot of people were doing. Because at the time, when you started, you needed to somehow write to the bank, and then the bank would take some time to advise and say, oh, you belong here, you do not belong here, you cannot do this, cannot do that. But now you had clarity. You could just go look at the payment license categorizations, see which you are able to do in terms of your financial capacity, see which you are able to do in terms of the product and services that you want to offer, and under what license categorization they better fall under. And so that has helped to bring some sanity and some clarity in the system. So there are others, of course. More recently, we have open banking, which is taking off this year, which would further allow a level of data interoperability that enables the fintechs to create personalized products because they have almost the same level of insight into your financial activities that banks have, the trove of data that banks have on your activities for years and years. And we are hoping that open banking would be another step or another platform that would enable the ecosystem to leapfrog into a development that the way that these other policies have done. So that is the first part, taking you through this to understand how the foundations and the infrastructure for this ecosystem that we are building has actually been majorly powered by regulatory activities and by policies and regulation, because building out some of these systems are very expensive endeavors. Now, we had NIP, as you guys have seen, since 2011, and then, of course, we refreshed NIP in 2016. The US Fed got NIP, or Fed Now, instant payment, in 2022. The Nigeria had been doing it in 2011. Because that is the level of effort, the level of resource, the level of willingness that it takes to build, for instance, an instant payment system. Brazil has Pix, which it brought out in 2021 as well, and a few South Korea also has one. Of course, the UK also has one, but not every jurisdiction around the world has an instant payment system. So that shows you the level of thought, the level of resources required, the level of will from the policy side to be able to set the foundations and the infrastructure that powers a growing and active and functioning fintech ecosystem like ours. So that's the first part. I think we can pause now, and then maybe if we have questions, if we have thoughts, and then we'll move to the second part.
Great, interesting conversation. And I like how you've taken us through the journey, right? You know, while you were speaking, it only shows that the regulators also understand the problem of the people. They're also solving for problems, right? So they think about the problem, they put the infrastructures in place, and then players or operators like startups or fintech now come into the building capacity, right? Because of course the regulators can't build everything. They need people to come support them. While this has been a conversation, were there trends that the operators were seeing, right? Because now your last few statements said, instant payments took time in some other countries, but of course we developed ours almost immediately, earlier, maybe not immediately, earlier than them. And this could have been as a result of the fact that our regulators are trend focused, right? So were there trends that while you were at the CBN, at your time at CBN, and also as a founder, when this thought process come in, what always comes to your mind?
So now, one thing that you would have to understand is that the regulator has more data on what's happening in the financial system than you as an operator, right? So today, as a regulator, I can know what the total payment value of the entire financial system was at close of business last night. You, as a startup making your market analysis, what you can know is the data that we published at the end of last year. So that level of real-time insight, and also not just the data that we publish, which is an aggregation. We can see trends, we can see movements, we can see anomalies, we can see patterns that inform some of these. And if we go back to NIP, right, we had NIPS, and then we had an automated clearing house as early as 2002. So by that time, we could already see that, yes, a lot of transactions are coming to clearing and then to settlement, right? And they've lead to 1 hour before someone gets a confirmation of that. And all of that is something that is very much, it seems normal, but it's affecting businesses, it's affecting transactions. You might not be able to tell, but when the consolidation happened in 2010 and banks needed to sell shares and all of that, like what's happening now, you had times where someone was trying to, let's say, make a transaction worth billions, and this transaction was time sensitive. And because he needed maybe an hour to be able to confirm that this transaction had happened, a deal that was significant and that was moving, that would move the market in a positive direction, would be lost because of the time bound. Someone wants to wait to confirm. So you have these little things. Also, another trend that we're seeing at that time was we're trying to push cashless policy. Now, the beauty of cash is, one, it's fungible, right? If I give you 1,000 naira, I give you 1,000 naira. It's not mine anymore. Two, it's instant. Cash is instant. And we were trying to bring up a system that was going to make people move from cash. So it had to be instant. The payment part had to be instant. The clearing and settlement, we could delay it. We can have the 4 cycles because the people who, or the institutions who had been appointed to clearing and settlement had the collateral. We knew that they were good for the money, so to say. So everybody was safe. But the payment had to be instant to be able to mimic cash because we were trying to do away with cash. And so these were the motivations. We had seen the trends, as you said, but we had an objective within the cashless policy to replace cash. And cash was fungible, cash was instant, um, and, and, and and value was delivered to the receiver from the sender immediately. So the payment system, the new payment system, the instant payment system that we're trying to put on board was such that it would mimic cash as much as possible for those new entrants to have confidence in this system. So that those were some of the motivations that pushed the instant payment
I hear you.
drive.
I hear you perfectly. And but with every policy or regulation, right, it takes time for stability.
Yes.
It takes a lot of time for stability. And in that gap of stability, can you just talk us through rollouts, like rollouts of policy, right? Because as a startup founder, you don't roll out almost immediately. You are testing with a smaller set of people, and then you are looking at the infrastructure. If the infrastructure is good enough to hold, maybe break at any point in
Mm.
time, just talk us through the rollout structure. How do you guys roll out? Like, do you just make the decision, the policy is okay, you've tested with the smaller groups or smaller forums, or your stakeholders, and then from there you go straight to the market. What I usually identify with most startups, especially fintech startup, when they roll out and they have that massive rush, there's the break most times, right? And that gives room for fraud, that gives room for a lot of hacking, ethical
Mm.
hacking or ethical hacking, however you see it, and a lot of people are testing. With policies, what happens most times as well is that people are building the reverse of the policy. How do you guys attend to this?
Okay. So one is policy, then the other is initiatives or infrastructure, right? So with policy, with policy, with the rollout of policy, the policy process is simple. It always starts from research, right? And understanding that there is a problem, there is a gap. For instance, we have corporate governance framework, right, for banks or for financial service providers. And what we see that, we we received every bank's annual reports before they make it to the public. We get them first. So we see that the boards of banks were barely meeting twice or once a year. So we see this trend for like 2 years. And I was okay, why is that? What does the guideline say? Oh, the guideline did not specify how many times. It just said you should have a board. So then we see, so the policy is the problem, right? So what do we do? And I say, okay, research. What are the global benchmarks for how many times a board was it? What are the benchmarks in other industries that are not financial? What are the benchmarks in financial industries in other jurisdictions? And then we start from there, from that research angle. And then we see, these are the standards. So we say, but you can't just do one, let's say, 1 point policy. Okay, what are the other issues that we've noticed in the system over the past 1 year, 2 years? And then we start going, so there's corporate governance here. There's this, we've seen non-executive directors automatically after some time becoming executive directors. We've seen executive directors moving to become non-executive directors. We've seen people set up banks and they are there for like 20 years as CEO and they are doing a lot of single obligor limit breaches where they are lending to themselves or to their proxies and all of that. So we gather all of these and we say, okay, we are updating the regulations around these and that and that. And then we do our research, we do the consultations, we do all of that. Then once you have the policy written as a draft, you then expose. You expose to the industry, not to the public, just the industry. You call people in. Most times it's fiscal meetings You call people in and you say, look, well, this is what we've observed, and this is the data. We've observed that you guys are meeting barely once a year. That is not good because the board has an oversight function. And there's no way you can have that oversight function if you're meeting once a year because every other thing is gainsaying. Because we require that if you meet every time, there are minutes of that board meeting, and those minutes are submitted to us. If you say, oh, don't worry, we update them every month, we say, oh, you send them an email or you call the person. We can't take that. We can't take your word for that. So this is where we are moving to. And then the regulators say, oh, this might become too much of an operational burden. This might become too much of a financial burden. This might become too much of a strategic disadvantage. We listen to all of that. We fine tune the exposure draft and then we put it out to the public as a form of forward guidance, because forward guidance is very important in policy as it enables you to observe as the central banker or as the regulator how the entire ecosystem will react. Because you know that at the first step, you are just talking to the operators, but there are more than operators. These operators have partners. These operators have customers as well, who are all part of this system. So when you do the public exposure draft, and then you solicit input. So at that stage, interestingly, sometimes it's even other regulators. So you can say, oh, you've moved the single obligor limit or you've reduced the single, and NDIC comes to say, this thing that you're doing now, by the time this bank goes under, we do not have the capital base to be able to pay people out deposit insurance, for example. So you have to then rethink that. Or you put it out and SEC comes back and say, "Oh, this thing is so stringent that it will stop both external and domestic investment into the country on the stock market if our companies that are publicly listed are required to do XYZ." So you have a conversation and you do all of that, and then by the time you fine tune and you're comfortable balancing one, of course, your need for the system to develop and to be against your need for the system to be stable, which is your primary responsibility. Then you roll out the policy. Now, sometimes you roll out the policy finally, and nobody likes it. Nobody likes it. And I'll give an example of something that I was tangentially part of, right? When the National Assembly put forth an amendment to the Cybercrime Prevention Act of 2015. They did that in February 2024. And within that, there was a clause that said, oh, there would be a cybercrime or cybersecurity levy, which would be levied on electronic transactions at 50 naira per transaction.
I remember that. Everybody keeps.
Now, now, when we looked at that, this did not come from us. It was the legislation of the government, as of the National Assembly. But we are the regulators of the financial system. So enforcement, to a large extent, will fall on us. So when we looked at this, we said, this is going to be problematic. But it was outside of our purview because this is a national law. We do not make laws for the country. We make guidelines, regulations for the financial system. But so a lot of engagement took place, but the government insisted that this is the approach they wanted. And we put forth the circular, and everywhere went to bits because everybody was up in arms. And so now it was not a protestation from us as a government parastatal to a government at the federal level. They had seen how the country has reacted, and they are representatives and senators of Nigerians. So Nigerians were clearly saying that we do not like this. And so they had to come back to us now and say, oh, please, please, please take that back. And we took that back. So you have instances where policy or regulation comes back and the response is very much unequivocal in how everybody does not like it. So you have to roll back, which is sort of like you as a startup putting out a product and it's breaking and people are not able to do it, and you have to roll back, you have to shut it down and all of that. So we too have instances like that. The other part is initiatives and infrastructure. So we have periods where before we roll out we do all the things that you as a normal startup would do. So we're putting out NIP, we are doing penetration testing, we're simulating
Product market fit.
video, we are simulating DDoS attacks. We are looking at what the throughput capacity is. We're saying, oh, do we have what is how resilient is and scalable is this infrastructure? Are we the technical guys here? Oh, do we have enough virtual machines to listen? What are peak hours? What are low hours? Will this be able to handle all of that processing power and all that? We do all of that, and then we test live. Sometimes, like the new RTGs, oh, we'll just say, yes, there are 34 banks. We want to start this with only 5 banks. And then we call the 5 big banks and say, we want to start this with you for a period of 3 months to see what this looks like. And then before we then take it to the whole market. And sometimes, despite all of that, when you take it to the whole market, the volume or the level of adoption that comes up becomes so much significant than what you expected. And then you have to go back and restructure. You have to go back and improve on the infrastructure, or even if it's not infrastructure, on the way that the system operates, or on the operational processes as a whole. For instance, when the treasury single account was instituted, and then we saw that, oh, there are some entities that they could not adopt this immediately because of the way their operations are. Some of them, like the NPA, like the NNPC, they make some of their revenue abroad. And if they're going to repatriate their whole documentation processes in place, that makes it difficult for them to make collections and payments within a week, for instance. So you have to then go back and create leeway for those people to do within a month. So it's a very similar process in terms of infrastructure and initiative plays that we take as the regulator, and a startup takes. And it's a very consultative process for policy. And we listen to how the market reacts. Just like you listen, if you see there's no product market fit, as you said,
Of course.
you might have to roll back that product and then concentrate on the ones that are working and are being adopted by the market.
Great. Thank you. I don't know if there are questions from the audience. You can just use the raise your hand button, and then we can take it, or just unmute yourself. So let's just wait for a while. I think that the other thing to say would be that what are the beyond the trends, right? I know you spoke about sandbox, right?
Yeah.
And a lot of people still do not understand how the sandbox comes into play, right?
Mm.
So maybe you just want to drop one or two. There are questions for you. Henry,
Okay.
you don't want to mute yourself. It's always best to, yeah.
No, it's fine. It's fine. I just
All right, go ahead.
Okay. Are we answering Henry or talking about the sandbox?
Let's talk about the sandbox, then we come to Henry's question.
Okay. So now the regulatory sandbox, as an idea, first stemmed from the Financial Conduct Authority of the UK, where they had seen certain innovations within the financial system that did not fall in the available regulatory or licensing frameworks. Also, there are certain regulations that were adjacent to existing frameworks, but had new models around them that they did not fully understand the risks that those models could possibly pose, if unless you saw them actually in function, right? So that was the basis, and then the FCA did the first regulatory sandbox, and then Singapore, and then we came on board. Now that same idea persists in Nigeria. You have, at the time that we started the sandbox framework around 2020 and 2021, you had the advent of crypto and digital services coming in majorly, digital assets coming in majorly. The management at the time, their first position was like, crypto, no. Everybody can remember all the guys, and Samuel B. Yele, all of them who were running Bundle, Netcoin, all of that,
Chad,
uh,
yeah.
that, all that. They'll remember February 21,
Love the love
2020.
letter from the bank.
It was a fantastic Friday. Everybody was eating fish and going to Kellogg's, and
Yeah,
then
and
you
CBN
opened their
sent
phone.
love letter.
Yeah, you opened your phone and you saw that, oh, your business was over. But so but then that was one instance. But there are several other innovations that come up that do not fall into existing regulatory structures. So the idea is, for the sandbox was that you have an idea, all the licenses that exist don't seem to capture the idea properly. You can bring that idea into a controlled environment, controlled in terms of both digital infrastructure and the number of users that you can sign up. And within that environment, with the observance and the guidance of the central bank and our other technical partners, including NIBS, we would observe this for a period of 6 months. You sign up people, you test it, you try it out. We'll see what issues crop up. We'll see what challenges go. If it's digital assets, we'll see what happens if someone gets defrauded, for instance. What are the recourse mechanisms? If someone fails to sign up properly, how do you handle it? How do you handle KYC, AML issues? How do you make so all of that happens within that controlled environment? So we limit first of all how many people you can sign up because it's a test. We limit what the levels of transactions are because it's a test. So if you say, oh, 10,000 naira is the maximum transaction value per transaction here, is because we want it to be in such a way that if, for instance, there's an adverse outcome, these people don't lose too much of their money or their livelihoods, and you are able to absorb that loss. Also, even you as the operator, you're bringing on something new, so you might not fully understand what the potential risk areas are. So we would learn this together. And when we're comfortable, two things can happen. One, we can give you a sort of approval in principle to go ahead and commercialize and use this product in the market. While we then go back and say, okay, this thing showed such an incredible demand that it requires us creating a license framework for this type of activity that others can do. Or when we test it, we see that, oh, people don't even adopt it. Or they'll be like, ah, it's a fantastic idea that you have in your mind, but it's obvious that the market isn't calling for this at the moment. So you either maybe shut it down or you can go to other jurisdictions where you think this might work. So that is the entire idea of the sandbox, the controlled environment for you to test new ideas, new products, new business models that are within the financial system that do not have a clear licensing framework at the moment in time. And so that at the end of the day, we can then decide how to proceed to commercialize moving forward.
Okay, great. So Henry's question says that he's building a marketplace and is integrating payments into the system, right, to enable him get transactions. Does he need a license to operate the marketplace?
Okay, so Henry, if you are building a marketplace, you do not need a license to operate a marketplace, right? You need your governance structure would include making sure that you're registered properly with the CAC, making sure that you have your data protection frameworks aligned properly in accordance with the Data Protection Act. So you get an NDPC audit done, and you get your certificate because you are taking people's personal information. When you're onboarding these people, when you're signing them up, you take their addresses, you take their names, you take their bank details. You need to have airtight data protection frameworks in place. So you get that from the NDPC. This is commerce, so you need to get the FCCPC to give you an approval for putting in place the right consumer protection frameworks according to regulation. But from the central bank, you do not need a license because the entity that you're integrating with, I hope for your own good, it's a licensed entity. Because if it's not a licensed entity, then in any of our checks, if we find that, oh, you're using some kind of payment channel and maybe those guys are not licensed, they're piggybacking on somebody else in a kind of third party framework, that's where you will have a problem. But once that entity is licensed, they are the ones that we regulate. So when we go to do our checks and our examinations, they would have the responsibility to tell us that, oh, Henry's e-commerce platform is one of our customers. We've done the proper KYC for them. We've done the proper AML checks for them. We've put them on the proper tier of customer that is required in the AML CFT regulation. And that we are fine with that. The only way that we come to interact with you is we go to examine that entity and we see that amongst its customers, Henry's e-commerce platform belongs, and it doesn't have the right documentation. It doesn't have the right KYC, AML, KYB in this case, because it's a business, structures put in place, and the right protections put in place in respect to the payment service that you've integrated. That's the only way we interact with you. But you do not need a license from the central bank to integrate with the payment service provider.
All right. So there's a trend in startups, right? The API trend, right?
Yeah.
Leverage an API. You're smiling already. I leverage an API from the fintech to power my wallet system. Right? The moment I have a wallet, do I need a license? Because I'm holding money.
So there are two things here in terms of money, the way a central bank sees money. The reflection of value, as we call it, that you see in your wallet, and value itself are two different things. So value is at clearing and settlement and deposits with a financial institution that's licensed. A dashboard or wallet that allows you see your balances held in a licensed entity's books is not the same thing as an account. That's one thing. Then I go to the next thing. Wallets also, as a repository that actually holds value, is very specific to entities that we allow to hold value. Those are a bank, that's a full commercial bank, a microfinance bank, a payment service bank, and a mobile money operator. That's all. If you are none of those ones, you do not have any right to have wallets that hold value in them. So if you're a payment, like, okay, let's look at this practically in the Paystack issue, right? So Paystack brings out Zap and it says, oh, we are allowing our individuals now to be able to have a wallet, to be able to do individual payments. We are no longer only doing collections and payments for merchants and all that. And it says, oh, yes, you now have a wallet, you have all that. The central bank says, oh, okay, that's beautiful. Within our license that we gave you a switching and processing license. A switching and processing license allows you to, one, develop and deploy payment gateways for collections and processing payments. You can aggregate pooled accounts and switch on behalf of the people that you aggregate. The value is supposed to be held in the settlement accounts that those people provide for you. You have no right under your license to hold any value or to advertise to your customers that you can hold value for them in a wallet, because you're not a bank, you're not a mobile money operator, you're not a microfinance bank, or you're not a payment service bank. So if you are given a wallet, the only way that you can make that pass any regulatory scrutiny is to say that, oh, this is a holding or a representative dashboard. It's just to show the value that this person holds. The actual value is with XYZ Bank. So, of course, after the fact of the fine to pay tax, they came up to say, "Oh no, we didn't mean that. It is Titan Trust Bank that is holding the value." But it was too late. You advertised as though you were offering people wallets, which you have no legal, no regulatory backing to do. So if you are going, which was something that I was going to go through in the later part of the presentation, but you asked. So if you get your license, you look at it carefully and see what that license allows you to do and what it doesn't allow you to do. The permissible activities and the non-permissible activities are usually within the first 5 pages of any licensing framework, because that's very important. It's something that immediately after the basic business requirement and the basic business requirements, the next thing you see is permissible and non-permissible activity. So except you're a mobile money operator, a commercial bank, a payment service bank, or a microfinance bank, you cannot offer customers any service that purports to be an account or to be a wallet that holds value. You can just say, oh, you have a dashboard to see how much you are paying in and paying out, how much you have held in the settlement account that you've connected with us. You cannot purport to show anybody that you are holding value, because your license does not allow you hold value at all. So you have to, that has to be something that you're very clear with, because as you saw, $190,000 for an early stage startup, that might be all the money you even raised. That might have been it. It might be all the money you raised, and if you pay that, you just close shop. So, but for Paystack, they could absorb that, and you might think that is high, but I've seen within the bank, I've seen higher. I've seen some of course, for discretion, but I've seen some of the startups that we have within our ecosystem, times where they've gone out of their permissible activities, been fined far higher sums than the $190,000 that you saw for Paystack. So that is something that you have to be very careful with. You do not assume. It's best you get a regulatory expert and say, oh, look, we are intending to build this new thing or this new feature. Is this going to be allowed or not? Sometimes you can write directly to the bank itself. Of course, the bank is a bureaucratic organization. It might take you a while to hear back, but if
let me jump in.
you have to get that direct permission, else you end up in trouble.
Don't you think that is a function of the marketing department not even understanding finance? Sometimes we see it as when it's good enough to attract, the customers to our side. We're fighting a war on the street. We're trying to get acquisition, and it sounds way better than saying, "Oh, you have a dashboard." It's just a dashboard. But when we say you have a wallet, in the mind I think it's just creating perception in the mind of the audience. How do regulators see the marketing of some products and understand where the startup is coming from? Or basically because it's wrong, then it's wrong.
Okay. So I'll tell you that the regulator is not interested in your marketing as a startup. The regulator is interested specifically in right or wrong, stability versus instability. So if you are trying to fight within this market, it's fine. Do your marketing. But anytime the regulator perceives a proposition or a presentation of your services in a way that goes outside of the license that they've given you, you are going to have a problem. This is not just a thing for fintech startups. Even banks, every year we find banks billions of naira. Of course, banks don't go out to say it. It doesn't go out publicly. They don't even report it because they are publicly listed companies, and any negative news affects shareholder value. So we find banks at the central bank billions of naira every year for different breaches that goes beyond the services that they're supposed to offer or certain corporate governance framework, or they go out to market certain products that they do not have an outright approval for. Now, an interesting thing is this, which you have to consider the startup. If you have a CBN license and you are about to offer a product and you are unsure about how to frame that product, you can literally write to the bank. Now, many people have done it, from Paga to Flutterwave. I know Piggyverse when they bought Abeg, which they changed to Pocket, right? They at least I've been across those. They've written to the bank and say, look, we want to offer this kind of product, and this is some of them are outside our regulatory purview, but this is the partnerships that allows us to offer it. And this is how we are presenting it. And sometimes we see that the presentation is wrong. And I'll give you an example. So you, as a switch and a processor, or as a payment service provider, or as a payment service solution provider, you do not have the right to issue cards. For instance, card issuance is not one of your rights. But you've seen some of them. You've seen Flutterwave, had Bata, you've seen all of that. How are they able to do that? It's because they are able to sign partnerships with a bank, which is allowed by regulation to issue a card. And then they present the card and says, oh, this card is powered by our Wema Bank partnership. This card is powered by our MasterCard partnership, because MasterCard is a card scheme. And so you can issue cards. Once those cards, and then the value is tied to a bank account, which they are not claiming to have. So what they are just issuing you is a card which is powered by MasterCard, which is powered by Visa, which are licensed card schemes. They're not saying, oh, this, we at Flutterwave, we can issue you cards. We at Flutterwave, we are issuing you this card, and it's powered by Visa, it's powered by MasterCard, it's powered by Amex. Or we are issuing you this card and it's powered by XYZ Bank. These guys are issuing this. Piggyverse, I'll go back to that. We, although at the beginning, when you were signing up and you're creating an account on Piggyverse, your Flex account, what did they tell you? This account is powered by Wema Bank. So in the advertising, in the marketing, and the positioning, they make it clear that, look, what we are giving you is the interface. The account itself is managed by Wema Bank, which has the regulatory approvals to be able to offer you an account or a wallet. So that marketing positioning has to be clear in a way that does not end up putting you in a funny position with your regulators.
All right, let's go to the second question from Henry. He says that, why do you think the e-Naira isn't working today, despite being introduced a while ago?
Okay, so I was very much part of the e-Naira project from the start to till implementation. And at the end of the day, three things, right? One is that the value of the e-Naira as a payment infrastructure paled in comparison to our instant payment services. Two is that it was unable to achieve economics of scale, which is very important for any payment service to work, in the sense that signing up and onboarding enough of the service providers and the both on the operator side and on the business side that would then pull in day-to-day individual users was not achieved. And that was not achieved because, one, the bank tried to execute the e-Naira on its own as an initiative. Unlike other projects where we would bring out the infrastructure and then allow the operators to take it and run with it. And that was because the bank set a very aggressive timeline for the implementation of e-Naira. June 10th, 2021, the central bank governor comes out to say, by October 1, 2021, we are going to have a digital currency. That is barely 6 months, right? The Chinese yuan project started in 2014, for example, and even as at the Winter Olympics in 2021, it was still in a kind of gradual pilot phase. Right. So see how long that was. Or the Eastern Caribbean Central Bank, their own digital currency, or the Bahamas digital dollar, and all of that. They have taken, or people like Sweden, who even started earlier than most, or Bangkok, or Cambodia, and the rest of them. These have taken long, and that duration allows you to do the normal process of extensive stakeholder engagement, getting the buy-in from operators, and then doing a proper sensitization to the ecosystem, including individuals, before you roll out. But that timeline was very aggressive. A lot of us had sleepless nights, and put in a lot of time and a lot of effort to be able to make that happen. But because that timeline was so aggressive, the banks, the operators did not have enough time to, first of all, set up the infrastructure that allowed them to integrate properly. Bear in mind that one, the EIDAR was built on the blockchain, right? It was built on the Hyperledger fabric. Most of the legacy institutions, the banks and all of that, did not even have the internal capacity to be able to do such integrations in due time. It was going to take them some time to get the right type of technical skills on board, set up the right type of systems to integrate, or not, sometimes not even to integrate, maybe to create some silos to protect their other infrastructure, because it's blockchain, they do not understand it fully. So that buy-in, that critical buy-in from operators failed to materialize in time. And then once it went live, those issues became apparent, right? So the early adopters who, in a normal diffusion of innovation trajectory, you see that the early adopters are supposed to become evangelists, because if they see a system, they use it and it works, they will be. But they saw the system, they used it, it didn't work as well as the alternative, which was instant payment, because of the teething issues that it had. So by the time even upgrades were made to bring it up to speed, those early adopters had given up.
Yes. Yeah.
So the next, they were not the evangelists for the next set of adopters. So this multitude of factors, ranging from poor stakeholder buy-in because of the aggressive timeline, to sensitization for the ecosystem, the daily users, that was not done properly, actually put the initiative in a position where it was not able to get the scale that was required for its adoption. So I think those are the factors that caused the INERA to sort of stagnate, even though it was a nice
Very good
initiative
initiative.
for the bank to have. Yeah.
Yeah, I think that one other factor around the era would be that the education was really very low. A lot of people were still wondering, what it was. And shortly after then, the prices of crypto was also looking very funny, and people were comparing if crypto is doing X,
Yeah.
the in-era is stable coin, is this or that. So education, played a very vital role in its success and its failure as well.
Yeah.
So let's see if we have any other questions. If there are any other questions, please just raise your hand while Ernest gets into the second part of his conversation. So Ernest, let's just quickly go back.
Yeah.
Is this also to say that regulators as well also fail, just like startups?
Yes, yes, yes. It's very much okay to say that. This, within the last 3 years, we've seen regulatory fails in different forms, right? We've seen on the central bank side, of course, the from the initiative side, the INERA, or the cashless policy in 2022 November, right? Which was not rolled out properly, which ended up becoming sort of counter productive, because I think for the first time in for the first time in a long time, in the period immediately after the whole policy situation with the new cashless policy sort of was resolved, we saw a high level of reduction in deposits into the bank because people were so spooked by what happened around that time that immediately it ended, they still wanted to hold on to their cash because they're like, oh, look at what happened with payments. People could not pay because the sudden surge in digital payments was such a way that the infrastructure was unable to handle, and we had breaks in the system for a period of like a week. And after the whole thing was resolved, still we noticed in the data that deposits into the banks fell for the first time in close to a decade on a month-to-month basis because people just said, oh, wait, let's just hold on to this cash. We don't know what will happen next. What if the next time I try to make payments, it doesn't go through like what happened during the peak of it in January, February, 2023. So that was a moment of failure. Now, unlike a startup, however, the regulator being a public sector entity, when it fails, it affects lives, it affects businesses, yes, but the regulator won't shut down. You as a startup, there's a level of failure that you would face that would make it impossible for you to do anything other than shut down. We've seen if you sometimes, oh, you have to shut down like a whole product line. We are seeing it with Okra now, and they're shutting down Nebula, which was their cloud payment service, their cloud service, and they're trying to focus on something else. We've seen sort of like Payday have issues and then had to close. We've seen Dash have corporate governance and issues in Ghana and have to shut down. We see Copia couldn't reach product market fit in Kenya and had to shut down completely. Trigger is trying to restructure and all that. Conga, one of the OGs, so to say, had corporate issues, had scale issues, had to be sold for a value that was significantly less than even the last funding round it raised. So for the regulator, they have the resilience being government owned and being government infrastructure, having to a large extent limitless access to resources to be able to eat up these losses and these failures and then continue to go. So you as a startup, you might not be able to do that. But the regulator has the elbow room to be able to fail and learn and go again the next day.
Okay, so there's a question from Thomas from Botswana. He says that what's a common misconception that foreign founders make when building for Nigeria B2B payment space that you believe is flat out wrong, acting as a founder from Botswana?
Okay, so one of the misconception for foreign founders coming into Nigeria, not just in the B2B payment space, is that they think it's their apps that sell. They think that, oh, if my app is available on the Play Store and it works fine and it's perfect, I'll be able to get market share.
Are you speaking as a founder now?
Yeah, I'm speaking as a founder now, which is flat out wrong, as you said, Thomas. Why? Because selling to businesses in Nigeria is a relationship-based affair. It's not a relationship-based affair in terms of maybe personal connections only, but in terms of the sales strategy, it would involve a lot of communication face to face. The business is not going out there searching on Google Play Store who are the people that offer B2B payments. You have to put in play. You cannot be over there in Botswana or over there in South Africa and say, okay, now I've entered the Nigerian market. My app is available out there. I have a partner out there and I'm ready to go. You need boots on the ground. Ayo is here. He was in the early days of OPay when they transitioned into from Paycom into OPay and what they were doing at the time. You need boots on the ground in Nigeria because B2B payments involves you onboarding an entity from as small as maybe a small store somewhere to as large as an airline. And that involves a lot of hand holding. If it's a large corporation, there are many stakeholders you have to convince. You have to convince the first point of contact that you meet, which is maybe the marketing manager or whoever that you meet. You have to be able to show him the value. That person will have to pitch your solution to the person above him that makes decisions. And that person has to finally get it to the management level where someone approves it. Because this is a serious relationship. This is something that would they'll bring their whole business on board to. And ideally for them, it's a relationship that's going to take years. So it's not a decision that anybody's going to take lightly. So that involves a lot of hand holding. It's a longer onboarding life cycle than what you would expect for a B2C approach where, oh, your app is there, you do your marketing, someone just goes up, they sign in 2 minutes and they are done. From approval processes in-house being integrated to the solution that you're offering to structures around accounting and finance and liquidity management and all of that. A lot of decisions go into it. So if you do not have boots on the ground, people dedicated in sales function that understand the product and are able to show value and walk these people through, you end up struggling. You will not be able to achieve that scale. Any any business that has succeeded on the B2B front has had to have a strong corporate sales angle. That is more important than how many product managers you have, how many developers you have, how many software testers you have. Corporate salespeople who understand the product and are able to walk those B2B customers through the process, hold their hand until the business gets sealed and you have business. Else, you won't be able to do that. So you need people that understand the terrain. A way that you approach a corporate client in Lagos is completely different from a way that you approach a large corporate client in Kano. They are within the same Nigeria. And if you don't have boots on the ground, people with that domestic expertise, you would certainly struggle. That's the key difference.
Ernest, let me lay out that question, right?
Yeah.
What infrastructure makes founders outside in diaspora, right? Outside Nigeria, what infrastructure does the regulator have in place that supports their success?
Okay. So the infrastructure that's available within the financial system is not designed to support success or failure of any operator. It is designed, first of all, to facilitate the efficient functioning of the system. Then it is up to you as the operator now to understand that infrastructure or get people who understand the infrastructure enough to be able to show you the rope. Because the function of the CBN is not market expansion. Our function is not investment facilitation for businesses that are trying to come in. The infrastructure exists and is there. You, as a Botswana or South African entity, can come into Nigeria and register and get a license to become a payment service provider. You can come and register. I know Thomas is from Botswana. I know a Botswana company called Letshego that has a microfinance, that has a microfinance bank license in Nigeria.
Yeah. And they have
right?
physical
So
outlet.
yeah, exactly. So you can, in terms of what we've done as a regulator is that there's no discrimination in terms of your your licensing or your access to the infrastructure. That is one. Every other thing then becomes incumbent upon you as the operator to take advantage of. You can come in at any time if you meet the regulatory requirements for licensing. It doesn't matter which country you come from. You are going to get a license. You are going to get the license and get plugged into the infrastructure once you meet the technical requirements. That is what the regulator does to make a level playing field. Every other thing besides that is contingent on the operator.
All right. Let me take us away from that conversation and go to like a B to C conversation. Most times, a lot of the fintechs that we see do not really have clear distinctions. How do the operators see this? I understand that for you, it's financial inclusion as far as you're concerned. More people getting financially included, right? But on the consumer side of things, it looks like it's almost the same products, right? Sometimes I say sometimes personally that some of these fintech apps should just be features on a very solid existing traditional bank or something, right? So for instance, you're building out an entire product for just tap to pay, right? Whereas a very big player in that industry can swallow you up. And then that also ends up, being a journey of failure, right? And you can also now be the biggest player with your infrastructure, and then you become like a NIMS, where you are even just giving out those infrastructure to different players within the fintech space. How do regulators see some of these things and, in their own space, say, it seems like this thing already exists. This person is just, how do you guys look at it?
Okay, so um, within the regulatory aspect is uh, we are not so much concerned around the proliferation of particular products or services as much as we are concerned about whatever those services are that they function properly within the rules. And I'll give an example of the only places where we start becoming concerned with proliferation. It is where a stated objective, because one of the things that in your licensing process, one of the things that you do is to state the objective for why you are setting up this business. And the space that we started having concern around that was microfinance banking, right? Now, when we instituted the microfinance bank licenses, the idea was, as I said, to promote banking services in underserved communities. So we made the structure such that you could have a microfinance bank that was a unit tier one and existed within just one local government. Then you could have a unit tier two that could exist in 5 local governments. Then you could have a state, and then you could have a national license. Now, we noticed that you come to us and you say you want to set up a microfinance bank license. I would say, oh, you need state, oh, you need tier one. So that's one local government. And we say, what's the local government? And you say Ikeja. I would say, what do you mean Ikeja? Because Ikeja does not have a paucity or a dearth of financial services. Every 2 meters you walk, you will find a bank branch. So this does not make sense because the entire objective for microfinance banks is to provide financial services in areas where there is a lack of financial services. So in such a situation now, that's when we become concerned about the proliferation because there's a stated objective for this license and you are not meeting it. Now, if we go back to payments, for instance,
Yeah.
right, as much progress as we've made with digital payments, as at end of 2023, when the whole cashless thing was going on, and we looked at some data, we still have around 70% of transactions in the country being cash based. Despite you see, when you see data and it says, there was 25 quadrillion naira in digital payments last year, and everybody's happy because it's a fantastic achievement from where we come from. But there's this significant levels of transactions that happen with cash. If you go to if you go to see deposits into banks, cash deposits into banks, and you see the hundreds of billions of naira, you as the guy who's building your payments stuff in Lagos, you're wondering, like, really, people are still using cash? But then you take a little drive and you go to Lela Market in Kebbi, and you see that people are selling everything from hundreds of tons of grains to cattle to all of that, and they're paying millions of naira with cash. Then you see that, an opportunity exists somewhere that you guys are not tapping into. So what is happening is there's a herd mentality within the ecosystem. Everybody wants to build similar products that have been validated because it's easier for you to take that and go to seek for funding from VCs because it's something that they understand. They have seen it work, so they understand. If you come up with a really innovative, different approach to either payments or any form of financial innovation, the only way that you would be able to succeed to fundraise is one, if you show incredibly aggressive growth at the very early stages that catches the eye of these investors, then you'll be able to do that. Else, it's just easier to do another payments thing where in a few months you'll be able to show, I processed 20 billion naira last month. The 20 billion naira that you're processing last month, as people in the ecosystem will say, I'm tired of seeing everybody selling recharge card in their wallet. But it's because that is very easy, and those are easy numbers, and they're straightforward numbers. Now, if you decided that, you know what, IDPs, we have over 8 million IDPs in the country, and when these people are displaced, they get some payouts, and most of the payouts is in cash. But within those, their ecosystem is because everybody's collecting cash. But then they are at risk. In fact, they could be robbed the next night, and you decide that, I want to make sure that every IDP in this country is using this closed loop payment infrastructure that I put up, and it's card based, and it's point of sale based, or it's QR based, and I aggregate everybody, and that's my niche. That is going to take a lot of work. You might just say, nah, it's better for me to still go and sign up IO and tell him that, he's buying airtime on XYZ digital bank app. I'll make sure that on my bank app, if he deposits money, he gets free airtime. That's just easier to do because I already understands that it's nothing too new, it's nothing too risky. It's simple mathematics. I process 20 billion, I take my 0.25%, and I'm able to show revenue. So there has to be a lot of risk taking because there are a lot of inefficiencies that still exist. I agree that we have a quote unquote saturation of payments product. But what I don't agree is that we have a saturation of fintechs. We do not have nearly enough fintechs. Insurance penetration in the country is around 8%. Pension penetration is around 8%. Insurance penetration is below 5%. That is financial services. All your VC funding that are raising, most of it is powered by pensions in Europe and the US. Pensions are huge everywhere else. It's clearly untapped. Insurance is clearly untapped. So the financial system, even investments, is clearly untapped. That's why you have people like CBEX can come up and millions of Nigerians will rush in because Nigerians are actually hungry for investment opportunities that make sense and that give reasonable returns. So I do not agree with the assertion that the fintech is saturated. I can agree to a large extent that payments is saturated, especially on the domestic front. But financial services, credit, we still have a $200 billion credit gap for SMEs in the country. So credit is not saturated. Insurance is not saturated. Pensions is not saturated. Investments is not saturated. Payments might be saturated, yes, but the financial system, the fintech ecosystem still has a lot of space for innovation and a lot of space for new services to come up.
Right. Thank you, Ernest. I think the other thing is maybe we look at it from the cities and then the remote side of things that are still left behind in inclusion or in acquisition. Right. So I'll let you go back to your documents till we have all the questions.
Okay. So the next thing is around what the regulatory landscape is. So in Nigeria, you have the preeminent financial services regulators. You have the CBN, right, which is the Central Bank of Nigeria, which regulates everything from lending, anything that concerns lending, anything that concerns payments. The CBN is in charge of that. Digital banking, all of that. Banking, payment services, lending services are under the purview of the CBN. Then you have the Security and Exchange Commission. Anything that has to do with investment, anything that has to do with crowdfunding, anything that has to do with capital raising, fundraising, all of that is under SEC. They have the Nigerian Insurance Commission, which is NICOM, which is in charge of insurance in all its forms. And then you have PENCOM, which is the Pension Commission, which is in charge of pensions. And then you have state governments, which also, interestingly, many people don't know, offer licenses for lending and for cooperative, which can also aggregate coalitions and aggregate value on behalf of members of a cooperative, or money lender licenses that allows you to offer lending services. These are the sectoral preeminent regulators. Then you have the adjunct or the adjacent regulators, as I call them. You have NITA, which is in charge of the infrastructure that allows you to manage data protection under the NDPC through the Nigerian Data Protection Regulation and NDPA Act. You have the Federal Competition and Consumer Protection Commission, which is the FCCPC, which manages everything from consumer protection mechanism, the recourse to disputes, and all of that. And then you have CAC, which, if you are a business in Nigeria and you're supposed to run a business, your first point of call to be recognized as a business is actually to register that business with the Corporate Affairs Commission. And then you have the Federal Inland Revenue Service, or the National Revenue Service, or the Internal Revenue Service, as the new act wants to call it, which handles all things taxation. And then you have the State Revenue Services, which handles at state level. So this is the landscape. This is the structure. So if you are thinking, I want to start an investment product, you are not coming to the CBN. You are going to SEC for your license. For everything from a digital broker like Shaka, Trove, and the rest of them, or you are a fund manager like PiggyVest, Carrywise, all of that is SEC. You are doing payments. You want to be the next Paystack, you want to be the next Flutterwave, you want to be all of that. You are going to the CBN. You want to be the next Zenith Bank, maybe. You're going to CBN. You want to be like Tangerine. You want to be like Awaba and all of that. You want to offer digital pensions or digital insurance services. You're going to NICOM for insurance. You're going to PENCOM. So that is what the regulatory landscape looks like. And then, of course, all those licenses that come with it. Now, another thing is, as a founder, which is something that I thought was important to share with you guys, just for the sake of knowledge, as a founder providing financial services in Nigeria, take a moment within your busy schedule and read up some of these things. One, and most importantly, is the licensing framework. So you can just go straight to what we call the new license categorization for payment service providers in Nigeria. That guideline breaks down all the different license categorizations for what we would call broadly fintech. The CBN doesn't, or the regulator doesn't have any license category called fintech. You're either a switching and processing company, you're a payment service provider, a solution service provider, you're a payment terminal service provider, you're a super agent, you're a mobile money operator, you're a payment service bank, you're a microfinance bank, or you're a full bank. So within that, you can see all of those different license categories, what the minimum paid up capital are for each of them, what the basic corporate governance frameworks are, what the basic technical requirements are. There's no way you can be a payment service provider in the country without having a PCI DSS certification. There's no way you can issue cards without having an EMVCO certification, which we offer, which the CBN offers in partnership with NIPS and accredited assessors of the EMVCO. So there are technical requirements. All of those are in those guidelines. So you familiarize yourself with those guidelines of licensing frameworks. The next thing is the Bank and Other Financial Institutions Act, which we call BOFIA 2020 rather. BOFIA is the preeminent regulation of financial services in the country, right? Everybody derives their powers from BOFIA because BOFIA is the one that says, oh, a bank is recognized as this, a payment service provider is recognized as under other financial institutions in Nigeria. And this is the powers of the regulator over them and all of that. It's a broad overarching. It was passed by the National Assembly, so it's legal, it's constitutional in that sense. Then you have the Securities and Exchange Act 2025, which is now new, which before was 2007, but it's been updated. With that takes you through all the responsibilities, all the categories of activities that are under the purview of the Securities and Exchange Commission. Together with that, you can also look at the set guidelines on digital assets, for instance, which they call virtual asset service providers. You can look at the SEC licensing framework for sub brokers and fund managers, which are the licenses that most fintech operators are getting into. You study these if you want to understand, if you want to have just a broad knowledge of this thing. And then for compliance, the Cybercrime Act, Prevention Act, which was reviewed in 2024, is one that you need to understand. The second thing is the CBN, AML, CFT, CPF Act regulation of 2022. That is the mother book of compliance. Even the other regulators leverage it to understand compliance in the sense of examining entities that are licensed. So you're a fintech. If a regulator is coming to you and they want to go through your books, they want to go through your operations, most of them will leverage that, the CBN AML CFT regulation for 2022, or the Cyber Crime Act. The Cyber Crime Act seems to be focused on cybercrime, but within it has all the structures for digital services around AML CFT broadly and generally. So in terms of the regulatory landscape, we've looked at who the main regulators are and what their different regulatory purviews are. And we've also looked at what are some of the key regulations that you should be able to understand, read through, or have basic knowledge about. So I think I'll stop here before I go into the next one. So just so that if I have questions on all that, then around this we can take them before I go into the next.
All right. I hear you speak about a lot of fintech and payment regulations. Let's talk about some of the industries, some of the sectors, sorry, not industries, sectors that you spoke about with potentials. right? Insurance, investment. Um, what are their own regulators or regulatory that they should also try to. I'm sure there are people in this call that are also their minds are being exposed to other aspects that they could also pivot to.
Yeah. So as I said, beyond beyond payments and banking, right? You have insurance and pensions. Now, the interesting thing about insurance is that around 3 years ago, right, the Nikon brought out a framework for non-contributory and artisanal sorry, Pencom brought out a framework for non-contributory and artisanal pension contributory pension scheme rather. That is a fantastic opportunity for people who are looking to build in the pension space because one, the pension licenses are very expensive. Most of them would be around if for you to be a proper pension fund, it's 5 billion naira, right? But with this new non-contributory and artisanal framework, it allows sub pension brokers who can partner with larger pension schemes to onboard um, these these semi-employed or unemployed artisans or employers or employees from SMEs, especially micro and small businesses that before now were kept out of the pension scheme because the pension scheme before then it was fully contributory. So in the sense that your employer had to pay in and then match from your own salary what it was. But some of these guys do not get paid monthly. Some of them get paid weekly. Some of them get paid from daily work. But if you are a startup and you see that there's a space for you to be able to collect contributions from SMEs on a basis that favors their cash flow, um, that does not that does not put too much of a burden on them. It could be literally you can collect 50 naira based on the artisanal pension scheme. You can collect 50 naira every day and create a whole new pension product that caters to guys that are artisans or guys that work for SMEs or small business owners that do not earn a salary. They just earn what their business makes and they take something off the top to take care of their daily needs. They don't have a salary, so they are not part of any contributory scheme. That is a fantastic opportunity right there. We have over, a Smedan would tell you that we have around 40 million um, MSMEs in Nigeria. And in all of that, there's less than 15% of them are actually medium-sized enterprises. The bulk of them are small enterprises or micro enterprises. So there is a huge opportunity there, taking advantage of such a policy framework to be able to, one, just partner with a larger pension scheme that doesn't, or a larger pension operator that doesn't want to be involved in those murky waters. Um, but you have the technology, you are able to aggregate data in different ways. You can just build something that layers, let's say, simple bookkeeping software where you're able to see how much this person earns, and you're able to do some form of risk analysis, and then layer pension on top of that. You aggregate these pension funds. The beauty of pension funds is you are encouraged as a pension administrator to invest the funds that you aggregate on behalf of your contributors into very safe assets, of course. You can't invest in Nigeria. You are not allowed to invest your pension funds into VC, but you can invest them into safe assets, into government securities, and all of that. So it's hugely untapped. I've seen people like Tangerine and try to go into that space. I'm sure you know Tangerine out of Lagos, and
Yeah.
they've tried to go into that space and they're making reasonable inroads in that space, and I think that's a fantastic opportunity for insurance. as well. Micro insurance embedded within underserved communities is a fantastic opportunity because, and I've seen people build it. You guys know Wella Health, Netto, and Netto started by charging people just 500 naira a month. 500 naira is something that almost anybody that does any form of work in Nigeria can afford. And with 500 naira, you got insurance cover if you had malaria, or just a cold or a flu, which were very common illnesses that these kind of people would, or every Nigerian would face throughout the year. And Network has grown up. I know Wella Health has over 1 million users, and there are guys like Awaba as well who are new within that space. So there are business models that these regulations allows you to take advantage of. The sub broker thing that you've had everybody Shaka Bamboo. Many people think, oh, the sub broker. It's more expensive for you to acquire a payment service provider license than it is to become a digital sub broker because it's just 10 million naira. That's just the minimum paid capital is just 10 million naira, while you need 100 million to be a payment service provider. It's fantastic opportunity because Nigerians are looking for investment, not just individual, even businesses. In terms of treasury management, businesses are looking for where they can deploy their funds within short time and earn something on top of it to manage their treasuries. So the opportunities exist within the different space based on the licenses and the regulatory frameworks that have been put in place by these different operators outside of payments, even commodities, right? You have guys like Afex, you have guys like Prime who are doing that. You have digital guys like Agriat who are doing similar things. Of course, the commodity license is very expensive, but you can layer on a partnership with people with the license exchanges and do warehouse receipts where you do warehouse receipts funding for either the agro processors themselves or the commodity traders. So these licenses exist. Robo advisory is still there. It's just 10 million naira. Now everybody's talking about AI, right? AI is everywhere. You can integrate with you might not have to even build it from scratch. You can have uh, Claude or any of the other existing solutions or Lovable to build you a simple solution and you integrate cloud and you can do robo advisory. And that would mean just integrating with an existing player or building it out on yourself. And if it's so good, and if the performance is so good, maybe one of the bigger players will just buy you off so that you become part of their offering. And with the 10 million naira minimum paid capital, you can get into robo advisory using AI and using the data that you have access to. So opportunities exist within these different spaces. Um, Payments became very front and center because of these successes and how loud those successes were, right? With Paystack, Flutterwave, Team App slash Moneypoint OP and the rest of them. But opportunities exist across the entire spectrum of the payment space based on the licenses or the policies that are made available by regulators.
Thank you, Ernest. I don't know if we have questions from the crowd. Let's ask the audience if there are questions. Please just feel free to raise your hands so that Ernest can answer the question.
And,
So I have a question.
Yeah.
Comes to this, right? I know that some of the practices that we've seen, usually in Nigerian fintech space, is that they get a smaller license, maybe a microfinance license to just roll out. For a startup that is just starting out, and you don't have that share capital to get the license and the rest, how do you approach it?
Okay. So There are two ways to approach this thing. One is there is a window, and I've not said this on my regulator cap now, I'm saying this on my founder cap. There is a window before you achieve a certain level of visibility where you can get away with white labeling solutions from licensed operators, right? And on the compliance side of it, you have to clearly state it that, oh, this thing you are doing is powered by XYZ, right? Just in case a regulator stumbles upon. Now, whose responsibility it is to make it clear to the regulator that the apparent is actually the licensed entity. And what do I mean? We have something within the bank which we call a letter of no objection, right? So payment service provider XYZ gets an approach from Thomas, and Thomas says, "Oh, I want to be able to give gamers the ability to sort of see a kind of wallet of their payouts within a game. For instance, that's just it. The license operator has to come to the central bank and say, oh, XYZ entity approached me. This is what they are doing. And within this thing that they're doing, they say they want me to extend them XYZ services, and which I'm licensed to do. Go or no go. And then if the CBN says go, we give them a letter of no objection. Now that's very important because you as the partner, you have a copy of that letter. So if you are engaging with anybody and they say, oh, you don't have a license to do this, you say, yes, true, I do not have a license to do this, but I'm doing this powered by this person, and I have this letter of no objection that the regulator of this entity said this was okay to go ahead. That covers you. But the thing is, within the bank, there's a certain level of threshold with visibility and activity. Let's say you now the licensed entity, we start noticing that when they submit their returns, we start noticing that 20% of their entire activities are coming from this partner. And they will say, oh, what does this partner do again? This is what they do. And they'll say, okay, we need to talk to this guy. Chief, it's time. You have to come and get a proper license because the level of activity that we're seeing you do requires higher levels of corporate governance, operational frameworks, security structures that you have to implement directly on your own end. We can't have them being only on the third party side alone. So come and get a license. And that has happened within the ecosystem before with certain new entrants, right? Trying to leverage on existing third parties. Others are direct partnerships where it's just clear. You are a piggyverse, you were starting, you had only around 400 users, right? Within the first few months. You are offering holdings, put money in your wallet, would invest it through our partnership with ARM, and we'll give you returns. We have a partnership with ARM for the investment side. We do not have a fund manager or investment license, but we are giving you people returns because ARM is investing on our behalf. Second, we have a partnership with Wema Bank. They are the ones powering the wallets on our platform where you are seeing your value. We at Piggyverse, our responsibility is to aggregate people onto this platform and give them the capacity to earn returns on their investments through these partnerships. Why are we doing this? We are doing this because unlike Wema, we have an understanding of the market for young millennial earners. We are, unlike ARM, we have the marketing know-how to be able to speak to young people, millennials, Gen Zs, who have disposable income and are ready to invest, but do not meet the minimum investment thresholds that ARM requires. So we aggregate the investment we aggregate the collections from them to be able to meet the minimum investment, and then we manage all of the front-facing part. We have these partnerships and we can do it. Now, as time goes on, you enter year one, and suddenly you've been able to aggregate 2 billion naira. And the regulator looks at ARM's books and looks at Wema and says, who is this PiggyVex customer of yours? Oh, these are these guys. The volumes that they are collecting on behalf of people, or the volumes that they are investing on behalf of people, has reached a threshold where we think it's more prudent and safe for the financial system that they have their own structures in place and we are able to directly have an oversight over the functions that they're doing. So those are two approaches that most people will leverage from the beginning. On the other hand, if you are doing lending and you see that, oh, a microfinance bank license or a finance company license has the regulatory scrutiny, the operational depth required, or the financial layout required at the early stages is too much for you, you can easily go and get a state money lender's license. Some of you guys like Lydia Kinde, who was formerly at Jumia in the early days, when Lydia started out their lending product, they got a Lagos State money lender's license. We have guys like Sycamore. When they started with a money lender's license from the Lagos State government and an approval from the FCCPC for digital lending, which I think the money lender's license at that time from Lagos State government was like 400,000 naira. And then they got the FCCPC digital lenders approval, and they're able to start from there. Now they have a SEC license for fund management, and they have a microfinance bank because they grew to that scale where they needed this. Okay, which is also to the next part of my conversation. But yeah, so those are the two approaches that you can take at the early stages.
All right. Thank you, Ernest. I think we should just allow you go into the next session because I might have like some follow-up questions that I would just like to ask at the end of the session.
Okay. So I might have a break in transmission in a few minutes because of a power change, but just giving you guys a heads up when that happens. So the next stage is to talk about the dimensions of fintech compliance itself, right? And then how does fintech compliance position you as a startup for scale? Because most of the understanding or the general perception or the general thought is that compliance for fintech startups is always a hassle. It's negative, it's bad, it's too much stress. But it's actually that's not the case fully because it has tremendous advantages. And then, so those are the things that we'll go to next. Then we'll look at the dimensions first, and then we'll look at the fintech compliance as leverage. So there are dimensions of fintech compliance. One is just general company foundation information. So when you are applying for a fintech license, you are required to have what is the business name? Where was this business registered? What is the address? Who are the people promoting this business? Those are
Oh, well, I'm thinking that was the power outrage that he spoke about, but let's just give him some time to come back. I don't know if we have any fintech founder in the house. This is like the best time to ask Ernest any challenge that you're going through, or if you're thinking as well to go into the fintech space. I think that's the best time to also get a hold of Ernest. Ernest he's been in the bank for a while, like you mentioned, being also a regulator, working with the Central Bank of Nigeria, and now pivoting into VC space. So far, so good. I'm just going to go around while we're waiting for him to come back. What's your take on the conversation? Let me start with you, Benjamin. You came in quite early. What's your take on the conversation? Sorry, guys, I have to leave. Thanks. All right, is Benjamin there? Henry?
Yes, I am.
Yeah, so let's have your take on the conversation so far.
Uh, I think so far so good. It's been very, very insightful. Though I am not building anything around fintech. Um, I'm trying to build something around the marketplace, which is totally outside the fintech in the fintech sector, right? But it's also good to know, I mean, learn all of these things happening in the fintech industry, the regulations, and all of it. I mean, it's been a very cool conversation, all through. Yeah, for me.
Hello.
Yeah, Ernest, I know you're back. I just want to take one
Oh,
more person on feedback of what they've learned from this. So let's have you, Vanessa, or yeah, Vanessa. What's been your take? Vanessa, are you there? All right. Welcome back, Ernest. I think you can
yeah,
drop.
thank you. Yeah. Yes. So, as I was saying, the first thing we look at are the dimensions of compliance. So, I spoke about like the general company information, foundational information that is usually required from you when you're just getting a license, and how this is important because if you're a business in Nigeria, if you're a business, there are basic things. You need to be registered with the CAC. So you need to have a company name that the business itself is known as. And within that registration, you need to then, who are the promoters of this business, or what you call the directors in the forms, in the CAC form, um, O7 or form O1 or form O2. Um, you have to then state how is equity shared between these entities and all and between these directors and all that. That is always required when you are processing a license for any of the fintech categories or any of the not just fintech, any of not from just CBN rather, any of the fintech categories across any of the regulators. That is basic general company information that is required. The next thing are commercial information and business planning frameworks. So yes, you say you want to start a business for payments, all of that. Okay, what is the commercial viability? It's a presentation that you usually make to the regulator, and it says, "Oh, this is where I see the business opportunity. This is what it looks like. This is the business plan." In that, from the CBN side, we require you as you're submitting that submit a 5-year financial projections or a minimum 3 years financial projection. What services will you be offering? How do you intend to make money? And all of that. Now, these are things that are foundational. So that's what I was saying that there's a perception that this is a hassle, but this is actually to your advantage because it forces you to sit down and think about your business. Because these are questions around business model. How does this business make money? The operator wants to know because if you get insolvent, it's going to have an impact on stability. If a bank collapses or a microfinance bank, iOS guys at OPay, they have over 30 million customers. If OPay through their Blue Ridge microfinance bank or just OPay as a mobile money operator, if they're to collapse today due to financial constraints, that is going to have serious financial stability consideration. That's why the regulators interested in knowing how would this business make money and how if that way that you're looking to make money is it sustainable. So that's the next dimension we look at. We look at the business information, the commercial information, and then the business plan itself. Then the compliance frameworks themselves around what are the permissible activities, what are the non-permissible activities, what does this license allows you to do. An MFB license and a mobile money operator license look the same until you now know that, oh, a mobile body operator license does not allow you to lend. That is why OPay might have a mobile money license, but decides to go ahead to get a microfinance bank and then bought our Blue Ridge to be able to. We are processing all this. We have this wallet through our MFB. We see the value that is coming in, but these deposits are not sitting with us. So we cannot do floats, we cannot do lending. And they go ahead to get a microfinance bank license because that license allows them to do lending. It allows them to do cash issuance. It's card issuance. It allows them to go all the way to clearing and then appoint a settlement bank. So these are the considerations. What are the permissible, the compliance frameworks? What are the permissible activities? What are the non-permissible activities? What are the caliber of people that are required to be part of this? I'll tell you, for instance, you cannot appoint your best friend. So I and I have an idea for lending. We apply for a CBN license. We cannot automatically just get one of us as the CEO. Why? Because there's a regulatory compliance aspect that says that for you to be a CEO of a microfinance bank license, you must have a minimum of 8 years experience in the banking sector. And then you must also have a CIB certification from the Chartered Institute of this for the Chartered Institute of Bankers of Nigeria, right? So these are things that protect not only you, the business, but everybody else, because whoever is going to be in charge of this microfinance bank, which is going to manage credit, which is going to manage deposits from thousands or millions of users, needs to be somebody that understands how the banking system works. It can't just be anybody off the street because they have an idea. So you can be the founder, but the CEO of that business, and call yourself whatever, but the CEO and you found a way to build a credit scoring system that makes sure that repayment is at 99.99%. But can you read the balance sheet? Can you understand as the regulators? And that's why we put these different regulatory and compliance aspects in place. So the other thing is contracts and agreements. We look at contracts and agreements because you are not offering this business alone, right? You have certain contracts. It could be, oh, you have a contract with someone who is doing your hosting, or you have a contract with someone who is doing your user acquisition. We want to see all of those contracts because we want to understand the extent of your liabilities and your commitments otherwise. And for you too, this is important because you learn to document things properly. You learn to document agreements. When you go into fundraising, investors will ask you for a founder's agreement. That is basically something that the regulator has forced you to have when you are approaching it for a license, maybe even before you got to have conversations with investors. Now you are ready because you went through a licensing process, and that licensing process entailed you bringing agreements around who had what equity to what level, or who were the third parties you have an agreement with someone. You don't want to build your credit scoring solution from scratch. You've met some guys that have built a fantastic um, maybe KYC solution. Maybe it's Verify Me or it's Smile ID or whatever. What is the legal basis of that agreement? Is it, oh, your friend Henry works at Smile ID and is able to give you access to the APIs? That is not sustainable. What happens the day Henry leaves Smile ID? What happens the day Henry maybe doesn't even leave, changes position, he's no longer in charge of the APIs? Does that mean suddenly you won't be able to onboard new users? So that is how contracts, agreements, commitments are not only useful for us as the regulators to put safeguards, they are important and they're useful for you to structure a business that is investable. That's why we're talking about from scrutiny to scale, because the scrutiny of the regulator puts you on the trajectory to scale. That is just what it is. If you look at it and you analyze it properly, the scrutiny of the regulator puts you on the trajectory to scale when you adhere properly to it. The other things are around technology and infrastructure. within every licensing framework, within every licensing structure, you are required to have certain minimum standards of technology and information technology and digital infrastructure in place. From your data storage, we have. I would know this. We for our payment service providers, our banks and all of that, we require that you keep data for at least 5 years. After these transactions have been completed, after 5 years, then you can archive them. After 10 years, then you can destroy. Why? Because you are engaging in an ecosystem that can become litigious. Because today, this transaction that you facilitated for this person might be clean. It looks clean. He met all the KYC requirements. You did all that and you passed it through. Now, as a result of an investigation 2 years down the line, it is found that the source of this funding was questionable. And then the regulator asks you, oh, let's see the data from 2 years ago. You can't say the data from 2 years ago doesn't exist. Also, it's important to you because 2 years down the line, an investor might want to fund you and it say, oh, let me see how your growth has been. Okay, I want to do due diligence. I don't want to just see your the thing you're showing me on your dashboard. I want to dig into the data. Now, because the regulator has forced you to store that data, you're able to call it up and give access to that investor or that large scale partner. If it could be a big bank and they want to partner with you, and they're like, let's see what your data storage infrastructure looks like, because we have a lot of customers and how that data is stored and secure is very important to us. And then because regulators made you set up these data protection systems and policies, and also made you set up the proper infrastructure to store and safeguard this data, you then have it on hand. It's just become part of your process. So that positions you better than someone who didn't go through that process. So assets and intellectual property is also the same thing. Oh, you build a business and it's fantastic and it's growing, and none of the core infrastructure belongs to you. You don't own any IP. Now, as a tech startup, your the difference between you and a normal business is one, hyper growth. Two, intellectual property. Three, the fact that as you grow, your marginal cost should be tending towards zero. That was what made software businesses so fantastic. So the one of the pillars which is that you own intellectual property. You are not unlike Walmart or Dangote. Your most valuable asset is not the physical refinery of brick and mortar somewhere. Is the intellectual property, is the code that you've written, it's the design of the product that you've put in place. Do you own that IP? It's very important to us because we don't want a situation where, as a regulator, 2 years down the line, um, Thomas comes and says, "Oh, he's leaving Henry's company," and then he owns the IP, and he says he's taking it. You can no longer use the IP, and does that mean the business shuts down? And if the business shuts down, what happens to the value, the monies, the savings that people have on your platform, or the lives or the businesses even that people have built leveraging your infrastructure? So assets, intellectual property, an important dimension to fintech compliance, and it's something that helps you. The data protection policies, risk management frameworks, all of those are business continuity policies. These are things that are important for operations, and the regulator requires it. There's no way um, you would you would get a license without submitting your own risk management policy. We call it an enterprise risk management framework. You must have it for your business. You must have a cybersecurity policy. You must have a data protection policy. The NITDA and the NDPC have data protection auditors. They would audit it, they would look at it, make sure that it complies with the NDPR, and you implement it within your design, within your product design, and within your operations. And then corporate governance is the final dimension, and it's very important. The roles, responsibilities, and oversight function of the different entities. For instance, the chief compliance officer of a business, whether it's a bank or it's a payment service provider licensed by the CBN, does not report to the CEO. In the organizational structure, in the way that the CBN recognizes, the chief compliance officer reports directly to the board. Why is that? Because he is supposed to be above executive management. Yes, in terms of your relations in-house, of course, he's at the same level as all the other CISO guys, the CTO, the CEO, and all of that. But his reportage, his line of reporting, when he puts together his quarterly compliance reports, he is supposed to report them directly to the board. Why is that? It's because compliance, as far as we are concerned, is supposed to be beyond your normal everyday office politics. It's supposed to be approved at the board level where both non-executive directors and executive directors have a line of sight. Now, we require that every quarter you present a compliance report to the board of directors. So when we come to examine you and we see there is a fine for that, there's a fine for that. And how many times have we seen within the ecosystem issues of, XYZ startup has lost 10 billion naira of customer businesses. And then it comes out in the media. And then your investors who are maybe on your non-executive board members or some of them your executive board, they're like, how? If you put in place compliance the way we had instructed, they would know first. It won't be something that will come out of me. And they'll know how to help you handle it, because the entire thing is that your non-executive directors or your board of directors, both non-executive and executive, are supposed to be people who are of a certain level of experience and a certain level of capacity within the industry that you're building, and they'll be able to guide you appropriately. And then you're also supposed to report when such breaches happen to the Central Bank of Nigeria or to the Security and Exchange Commission or to the Nigerian Insurance Commission, who are your regulators. If the CBN finds out in the news that you had a data breach and you lost people's money, as you're looking for money to pay those people for that data breach, also start looking for money to pay for the fine that is going to come to you. But if we know, because you have the right reporting lines, if we know beforehand, then we are able to work with you to mitigate. We've had instances where we've had entities that had data breaches, had attacks from malicious hackers and all of that, and they reported immediately. Some of them the same day, as soon as they knew what was going on. Dotun was talking about it, right? When he was in the bank as CTO and they had their data. I know the bank he was talking about, but when they had that data breach, the next morning, it happened over the night. The next morning, as soon as we resumed work, the CEO had informed the central bank that, look, last night malicious actors attacked our bank, and we're trying to piece up what happened, how much, and all of that. So we then start working with you, because sometimes you found the accounts where the money needs to, you need to do a post-note debit, or you need to recover it through a global standing instruction. The CBN can even help you because you have reported and you know. So compliance, these are the dimensions, but more importantly, compliance is a leverage. Compliance leverage helps you to build investor and customer trust. It helps you to enable partnerships that make sense and are beneficial to you. It reduces your risk exposure. It enhances your structure, the structure of your business, from just a ragtag bunch of ambitious young men to a business that is actually investable in. So that is in terms of the dimension and in terms of how it is also a leverage. The proper licensing, the proper structures, they give investors confidence. Your data protection, if you have all of these things properly, if an investor meets you and says, oh, we are going to do due diligence, set up a data room, it won't take you months, and then it won't take you having to scramble and having to ask, maybe getting some new people to come and help you fix all of that together. If you were doing this thing, if you were reporting properly, you had your policies in place, you had your structures in place as required by regulation. When an investor asks you for a data room, you just need to make a few tweaks here and there to be able to set up a data room that they can look through and they can do their due diligence. Oh, you say you have a partnership with this person. That is the data, that's the information you present to the investor. Due diligence level 1. Let me see the contract. You have it right there. It's there. Due diligence level 2. Let me talk to somebody at the other end if they know you. Oh, chief, I'm looking at this company. They have a partnership with you signed and dated August 2024. Do you have this? Yes. Okay. Can you send me a copy on your own end? Due diligence complete. If you had done it based on, oh, Henry has access to the APIs, and I say, okay, fine. You say you have a partnership with this guy, it's apparent. Okay, yeah, show me. Let's call Henry. That you fail the due diligence. Let's call Henry is not a sustainable structure where for an investor to be able to put in money, because they are your VCs or your PEs and all of that. They are custodians of funds on behalf of their own LPs, and they have to be very fastidious and conscientious with how they invest the money. So fintech compliance, even though it's a scrutiny and it is a lot of work and it looks inconveniencing, it's also a leverage for scale, for sustainability, and for structure. So the second to the last part of my presentation. If I think we'll stop here then before going to the last part.
All right, great. Thanks for all that input. Very detailed. And you've touched on everything that a startup founder should, put in place beyond just regulations, governance and the rest of it. And I think that that's very, very good. Again, it also shows how you're pivoting from regulations, from a founder lifestyle to a regulator, and now the VC side of things that you're also going into. So thanks for that. I want to quickly go into the last part, if there was a last part, but if not, I'll just go straight to a few questions I have from you. From an investor and partner perspective, how much does a startup regulatory posture affect the attractiveness for funding or partnership? I know you touched on it, but like just one in a few words, how does it really affect the attractiveness from
Okay. So it starts off regulatory process very important to an investor, especially in industries that are heavily regulated. Health, for instance, and financial services, right? So industries like climate and like climate, for instance, or agriculture and all of that are not as heavily regulated. So you have a lot of elbow room. If I'm looking at an agri-tech, if I'm looking at the climate tech startup, I'm looking at what's the solution? Does it scale? Does it make the impact that it claims to make? Because these are impact driven. If I'm looking at a health tech startup, I know that there's significant regulation around health. Well, you cannot have a startup that claims to be offering, let's say, on-demand medication delivery. You are offering pharmaceutical services. By regulation in Nigeria, one person on the executive management team has to be a licensed pharmacist to set up any kind of pharmaceutical business. So I'm looking at that and I'm thinking there's a risk factor. If I put in $200,000 in this business, and one day, 3 months down the line, the regulator says, okay, we are aware of these guys. You have been operating without any form of license. We're going to shut you down. I lose all my money. That is money that, because every time you take a decision as a venture capitalist or as an investor to invest in a business, you've forgone maybe 100 others. So that you have a plethora of decision points. And for certain industries, regulatory compliance is significant. Financial services is another one. If I have 10 startups, I've whittled them down to two, they're neck and neck. One of them has a regulatory license, the other does not have a regulatory license. And every other parameter, they seem to be very close. I'm going for the guy that has a license because I understand that the license is leverage. Tomorrow, he can decide to pivot this license into something else. Also, I'm looking at the risk. If, for instance, this doesn't succeed, tomorrow he can literally just sell that license, just that license, and return me my money. So I will not go home with zero. And it has happened within our ecosystem. It has happened. We've seen some startups over the past 2, 3 years that had licenses, and when they were not able to reach product market fit or all of that, what they were able to sell was that license, and they returned some money to investors, and the investors at least not ending up going with zero, getting back the minimum that you put in. So in certain industries like financial services, health, um, regulatory compliance is too important a step, especially as we move from pre-seed towards seed and then Series A and future investment. It is sacrosanct that the entity I'm looking to invest in has the right licensing or regulatory compliance posture.
So my next question, if you were going to advise the regulators today, what changes would you advocate for to help fintech grow responsibly?
Okay. So one change which I sort of tried to do significantly was in the digital asset space, right? I believe that there are fantastic opportunities in the digital asset space, and I've advocated for regulators, both within the CBN where I was and as the Security and Exchange Commission, to be more flexible and open to understanding that space. We are seeing stablecoins driving payments across the world now, and with the Genius Act in the US and some of the new executive orders, we are seeing that even large financial institutions are beginning to step in and play in that space. And for us, especially around remittances, cross-border payments, stablecoins and digital assets present an opportunity. I would advise the regulators to be more accommodating with respect to their licensing and their policy frameworks around digital assets. And I have advice. It's not that I would advise. Right now, we have just two licensed virtual asset service providers or crypto exchange in Nigeria, and that's Busha and Quidat, right? And I know at the time, close to 80 different types applied when we're doing the accelerated regulatory incubation program with SEC. So that's this one. The second thing is that I would also advise the regulators to be a little bit more accommodating of startups in the early stages. Because as I said, if the CBN approach gets notice of you trying to build a new product like what we saw with Paystack, or you are just a new entrant and you are breaking the regulation in any way. The fines are crazy. Okay, I'll give you an example. So you breach the AML KYC regulation, right? You do not properly follow that in terms of onboarding and all of that. We come in and there's a baseline. Now, for every additional person that will find that you have not signed up properly, you pay 50,000 naira. So imagine you have 10,000 such people that you fail to sign properly using the right KYC, and you're paying 50,000 naira for each. And you have 10,000 of such, or you have 20,000 of such. Because sometimes in trying to drive inclusion, especially if you are serving the underserved, some of these people do not have the most well put together identification information and all of that. And you still are trying to get market share. So some level of flexibility and understanding in terms of fines and sanctions when startups at the early stages breach would be another thing that I'll advise the regulators to consider, because they're quite stringent. So those would just be to keep it short.
All right, thank you. I'll let you just do your maybe final round and round of statement. Yeah.
Okay. So the final things I want to say is that when you're trying to get into this space, check what service you want to offer. Check what licenses are appropriate. Engage your fellow ecosystem players, those who are ahead of you and have gone through this. Engage an expert to guide you. Engage the bank even. You can literally write to the bank. I used to receive a lot of correspondence from people, international, local, that were looking to, and it was the duty of staff to respond to those inquiries, whether it's by the same letter or by email. So write. The second thing is, now that you are building, from the very beginning, embed compliance into your product. As you're drawing your product roadmap, as you're drawing up your product design, embed compliance into it. From how to protect data, how to manage consent management for data, how to make sure that the right KYC steps, KYB processes are taken. Embed those in the design. Do not make compliance an afterthought. Embed compliance in your product design. Establish controls and reporting very early. It's a very important part of compliance, and it's very important for your business. Reporting, controls, documentation of processes, sacrosanct. It is sacrosanct. Always from the very beginning, start from that way. If it's simple things as, oh, today we had a meeting on XYZ, this is a one-page summary, to this is how we onboard a new guy, it's documented, to this is the onboarding process, it's documented. Documenting, reporting, controls. Who has access to what? Because sometimes breaches are not always from outside. Some breaches are from inside. And without controls, you would not be able to properly do an audit trail to find out where things went wrong. So that's the other thing. Controls, reports, documentation. The other thing is engage. Engage experts, engage partners, engage industries. We have Fintech Association of Nigeria. There's corporate, I'm a member. There's corporate membership, there's individual membership. They have fantastic resources, just like iOS Umbrella Saturdays. They have weekly, monthly webinars as well, where they bring experts to talk about things. Join these communities, join this association, join your founder communities, talk to them, read. It's very important. As you begin to grow in your business, as your business begins to expand and processes and things like that function properly, your most important skill as a leader or as a founder is knowledge and stakeholder management. Those are the two things. So you have to understand your business in and out. We have meetings with some founders, and you can see that they have a full grasp of things. And in that way, you are able to provide better direction for your business and for your partners and for your employees as well. So you're not doing that just for yourself, but you're doing that. So read, learn, make it a continuous process. Partner, make compliance clear within your structures. If on your website, as I was talking about marketing, we are offering this powered by this. We are licensed by the CBN. Put the logo there. These little things, compliance breeds trust. Show, indicate in your marketing, in your designs, in your embed compliance, show compliance. Another thing is try to educate your users, right? Because your users are the first point of breach compliance-wise. The other people allowed us to sign up with just only our name. They don't ask us for anything. Content. small 1 minute video, 30 seconds video, a small blog post on your website, all of that, saying, oh, this is why we do KYC. A company that is very fantastic at that, interestingly, is Paystack. Another one is RiseVet. They'll tell you, oh, today a new regulation came from the central bank. One-page explainer, how does this affect you going forward? So you breed confidence, you breed trust. So make compliance part of your strategy, make compliance part of your communication, part of your consumer education. That helps you. So from scrutiny to scale, my final word is that scrutiny from the regulator and compliance is not a hindrance, it's a leverage. It's a leverage for growth and it's a leverage for scale when you apply it properly. Thank you very much.
All right, thank you very much, Ernest. I think I just have one last question for you, and we call it a wrap. What's your final advice to founders navigating the tension between innovation and compliance? Final advice.
Okay. Yeah. So you are an innovator. Innovate. Do not, I'll put it in a sort of popular parlance, right? As much as you can afford to, in a competitive market, it's better to ask for forgiveness than permission. Because if you see an opportunity, pursue it. You can always come back to align with compliance frameworks. But if you allow the opportunity to go, you are surely going to lose your whole business. We've had people who were here first. When you heard me listing the earliest licensees that we give, right? Some of them were Cellulant. I don't know what's going on. I know that they had some issues and they were trying to restructure. I know that there are some entities that we knew in those early days that did not take advantage of changes in regulation, did not take advantage of new innovations, or did not take advantage of changes. Oh, NIP came on board. You're still trying to do NEFT because NEFT seems secure. You've been using it all around. There's people are doing stable coins now. There's an opportunity. There's a way you can layer it under what you're building as you understand it properly. But you're saying, no, you're not going to do it. Your competitors are doing it. The only thing is when you are clear-eyed about it, you know that, yes, and a moment will come where you have to come to comply. But if you hesitate too long, I'm talking to you as a founder now, if you hesitate too long, you lose momentum and you lose market share and people go. And then it becomes too late for you. We all of us here, we had Western Union and all the other guys. Now, if you ask anybody about their remittance, what are they doing? They're using LEM5, they're using WISE, they're using all of that. It's because a change happened in consumer expectation, in approach to the market and all of that. And they failed to take advantage because of hesitation. So always, your first thing is you're an innovator. Innovate first. The regulator's responsibility is to make sure that you comply. They will take care of it one way or the other. Innovate, innovate, innovate. Do not wait for regulation. As far as you are not yet breaking the law, always move forward to innovate. Do not turn back, because this is a very competitive space and the market and your competitors are not waiting. The regulator would always do their job.
Thank you very much, Ernest. I don't know if we have any questions from the audience for Ernest. You can just raise your hands up. Neil. Thank you, Ernest. Thank you, Ayala. I'm really glad to be a part of the session. All right. Thanks for the feedback, Henry. I don't know if there are any questions, but in the absence of questions,
I have.
Go ahead.
Hi, can you hear me?
Yes, we can.
Okay, good afternoon. This This has been such an amazing session. I'm not building a fintech, but I've learned so much that I can implement even in my space. I'm building a maternal health tech solution, right? And but one of the features or one of the programs that we offer is that we allow for moms to be able to build like a sort of like a what's it called now? Like a plan where they can get people to give them money or stuff that they can use for their journeys. I think my question is that would you advise, I don't know if you can advise in this regard though, but because would you advise that we hold money or we collaborate with an existing fintech to collect money, or do we build a wallet system that helps moms to save? How would you advise we go about this? Because we are not a fintech. We don't have the license to hold money. So how would you advise we go about this? Thank you.
Okay, so there are a few things here. One is the fact that, okay, you want to give them sort of the ability to collect donations or payments from people. So you need a payment processor that will offer you gateway services for the collection, so that it doesn't matter whose account, which bank this person is paying from, they can collect. So you need a payment processor. It could be because your guys can just go do a pay stack. The API documentations are there, and you're good to go. Now the thing is, when you collect this money, do you want them to directly go immediately collect it, they go to the person? If that's the case, then you don't it's not a wallet system. You're just you have a gateway. The gateway is aggregating. They can just see the dashboard and says this is how much you've collected on their behalf, but the money immediately settled into their account. If for some reason you want to hold this money, um I don't know, for whatever reason you want to hold it, maybe you want to have the float over a period of time to invest or do something with it, then it means that the money goes first into your own bank account as a business, and then it's from there that you pay out. So in that sense, you are giving them some form of virtual accounts where, yes, they can see their money, and each of them has an account, so to say, in quote, on your platform, but value itself sits in your own bank account. It doesn't sit in any of those wallets. Either way, you need a third party service provider. It could be Space Stack, as I said, it could Flutter, it could be any of that. It's not something that you can do on your own because you have no license to do collections. You have no license to offer wallets as a bank, or you have no license to do aggregations or payments. So you get a payments partner, depending on what model you want to do. If it's just collecting and settling to them immediately, then it's just a dashboard that shows, oh, this is how much we collected on your behalf. It's not a wallet. If it's good, if you are going to hold the money for some time, then you show them a wallet and says they have this XYZ money. If they decide that they want to withdraw it, then you take it from your account into the accounts that they have designated to be paid out to. So in that sense, you are giving them virtual accounts in code where they can see the value that they hold. But if you're not doing that, if it's a direct payout, then you don't need anything. You just need messaging. You could just be messaging on the platform, total that you've collected on your behalf for this period. The money is in your account. As we're collecting it, we're sending it directly to your account. We're taking a share of the transaction charges with we're splitting the transaction fees with what do you call it, the payment processor, and whoever is doing switching, and then we're not holding anything either directly or indirectly. So it depends on what you want to achieve, and then either of these two, you just need a payments partner that can facilitate that for you.
Okay, that's helpful. Thank you so much.
All right. Any other questions? I think we're fast spent into the hour. But I'd just say thank you very much, Ernest, for such an insightful and grounded conversation, from unpacking the realities of regulators or regulatory pressure to highlighting how founders can build, build their own startup with regulatory compliance in mind. The session has made it very clear for us to know how to navigate the Nigerian fintech rule, and understand that it's not just about marking the legal checkboxes, but of course having a growth strategy in place. For founders in the room, I basically hope that you were able to understand, and this serves as a reminder that scale is possible, but it starts with clarity, it starts with intentionality, it starts with a deep understanding of the rules that plays, and also having the regulators as friends, um, thereby playing by the rule. On behalf of the Umbrella team, I want to thank you all for joining this session today. Let's keep building, let's keep learning, and let's keep pushing beyond boundaries responsibly. That's the word. Thank you everyone for joining the call. Thank you very Ernest for being my guest on this call. Thank you for doing justice to the topic. Next week we have someone coming online who will be giving us a fantastic intake into how to scale from Lagos to Toronto. We'll be having Sheon Oyajumo joining us. He's an ex-founder. He exited his startup. So some of the conversations we'll be having will be around exits, scaling, exiting, and also venturing into other stuff as founders after you scale. Thank you very much for your time. Thank you all. Ernest, thank you very much. I'm much grateful.
Thank you.
You have the chance to speak to us about Pulaspace. Do you want to just quickly do that?
Yeah. So yeah, Pulaspace, as I said, is an enterprise support organization. We mainly support startups with investment readiness, training, facilitate access to investors, and then we support them on their growth journeys that they're looking to enter new markets that we have a good network in across Southern Africa or East Africa. That is what Pulaspace does. We also are currently in the process of raising a $10 million venture capital fund to invest specifically in startups in smaller tech ecosystems on the continent. So outside of the big four markets, that's what we do at Pulaspace, and we are always welcome. We're always welcoming towards startups, not only from those smaller ecosystems, but across the continent as a whole. You can go to pulaspace.com and submit your information, and we'll reach out in any way that you might require our services or our support. That's what we do at Pulaspace. Yeah.
Sounds very interesting, and that brings me to the next conversation. We're launching something very new, very interesting. It's called the Pitch and Peer, where founders would come and be matched with investors. And of course, we have it backed by different backers. Of course, we would have a session with Pulaspace, where they would back one of the sessions, and then of course we'll look at founders in other regions outside the big four. That's Nigeria, Ghana, Kenya, South Africa, Rwanda, and the likes. Just basically looking into regions where innovation and technology is driven by smart founders who are verified, who are also vetted by Umbrella. Umbrella basically is your market space for startup investment and exit. What basically we do is connect verified African founders with investors and advisors. And by just so saying is that we ensure that we take you through an investment readiness process, similar to what Pulaspace does. Take you through an investment readiness process. We run your verification, and then we ensure that there's a due diligence that we do on the back end for you before you get into the marketplace. Just basically building or bridging the trust gap between African founders and investors, ensuring that we raise more responsible African founders out there. Thank you very much. Till we see next week. As
Thank you.
host, Ayola. Bye.